market risks are a little bit elevated.
As investors, we have to trade this market.
The equity market is basically back to a high.
The market is going to need good news to continue moving higher.
In terms of the U.S. equity outlook, that's going to be about the earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, looking to take down the temperature.
I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points.
As the president has said himself, he has always had a very respectful relationship with President Xi of China, whom he spoke to directly last week.
So I'm very comfortable that this deal is about to be closed. It's going to be closed not with a bunch of staffers and bureaucratic language, but with handshakes.
The US and China convening in London for trade talks, both sides looking to dial back the rhetoric as equities sit just 2.3% shy of all-time highs. The economy resilient in the face of policy volatility. Heading into the latest read on inflation, the Federal Reserve entering the blackout period with the president doubling down on his push for lower interest rates.
Yeah, remember, just on Friday, and welcome back, John. It's great to have you back. Just on Friday, we got a Truth Social post from Donald Trump saying, go for a full point rocket fuel, telling Jay Powell to really cut significantly. We do get CPI on Wednesday at a time that Friday, good economic data meant bad news for rates markets, particularly in the close-term markets, the near-term debt markets. It raises a question. How much momentum actually is in the economy at a time when you do have equities near all-time highs?
You've circled the right dates on the calendar. Wednesday, Thursday, CPI, PPI, but it's not about the data. It's about your debt supply. A 10-year bond issue, a 30-year bond issue. If you ask people this week what they'd like to see, I think the outcome of that, they'd like to see that ahead of time to get a real feel for how this week is going to go.
Let's just put this into perspective. Everyone has made fun of me for many years for focusing on the bond auctions. Everyone's joined me. They've come this way. We have made bond auctions great again. We have $39 billion of 10-year notes being sold on Wednesday. And then we have $22 billion of 30-year notes on Thursday. Two key risk events to gauge just how much demand there is for assets that a lot of people say are very difficult to really get your hands around. It really raises a question about how much CPI data really goes into this versus some other dynamic or even some of the trade negotiations that we see going on in London right now.
So let's talk about the trade talks. Annmarie's over in London this morning. We'll catch up with her in just a moment. Personnel's interesting. Commerce Secretary Howard Lutnick is in the mix. It's good cop, bad cop with him and Secretary Bessent, maybe. Objectives. What are the objectives for these talks this week in London?
That's the key question. Ultimately, are you getting some sort of parameter for what the strategic decoupling is going to look like, what the contours of this relationship are going to be? Do you get a sense of just a reaffirmation of what they got in Switzerland, particularly when it comes to rare earth minerals? It really spotlights the dependence the U.S. has on China, not only for the rare earth minerals, but for the distillation of these, which is actually very difficult. That is 90% coming from China, and it raises this question of how does the U.S. have a lot of cars at a time where they are so dependent on China for elements that really go into cars, into military equipment, into our phones.
Equity markets very close to all-time highs as these trade talks kick off in London. Equity futures this morning positive by not even 0.1%. Coming up this hour, the lineup looks like this. We'll catch up with Keith Lerner of Truist after upgrading U.S. equities, Elizabeth Economy of the Hoover Institution as the U.S. and China come to the table, and Andrew Hollenhorst of Citi pushing back his call for the first interest rate cut. We begin this hour with our top story. The U.S. and China set to resume trade talks today in London. Joining us on the ground is Annmarie. AMH, good to catch up with you. Let's talk about objectives. We know the stage is set for the U.S. and China. What is the ultimate goal this week?
Well, Jonathan, it depends. For Washington, the objective is really to make sure that they can get access to those rare earths, those magnets that are things like mobile phones, the high-tech and defense industries. And this is something we heard Kevin Hassett, the NEC director, talk about over the weekend. He wants to see a more advanced pace of those rare earths and magnets coming into the United States. And he said on the phone call that President Trump had with Xi Jinping, which set up the second round of talks. Remember, the first round was in Geneva just about a month ago. ago, he said that President Trump said, let's meet somewhere, let's meet in London, and let's have a handshake when it comes to this. For Beijing, what is critical here, and you really insinuated at the top of the program there, talking about the personnel changes. There's another individual that is now going to be joining Secretary Bessent and Ambassador Jamieson Greer, and that's the Commerce Secretary, Howard Lutnick. And Signum put out a note talking about the fact that now that we have Howard Lutnick at the table, this could potentially signal that President Trump is willing to ease export controls on the semiconductor industry, or potentially it's at least the White House putting that on the table. Both of these issues, for the United States rare earths and for China semiconductors, are the red lines, Jonathan, and the choke points.
Annmarie, just build on not just these talks, but the talks happening elsewhere and the deadline that is quickly coming up on the horizon, only several weeks away from the start of July. And once we get into July, that 90-day window, that 90-day pause, that 90-day window closes.
Absolutely. So I would say there's two tracks for different countries. The first track is for a number of countries with Reuters reported that USTR sent memos to them saying, send us your best and final deal because we want to set new tariffs rate by July 9th. They want to get these deals done. And you cannot negotiate with the dozens and dozens of countries that they have at the table. The second track are for those that are already in talks with the United States. Think of Japan, South Korea, the European Union, and Switzerland. I was actually in Switzerland last week and caught up with their top trade negotiator, who's been going back and forth between Bern, Geneva, Washington, D.C. And what she said to me is that they are an advanced track. And what she has been given assurances by Secretary Bessent and Ambassador Greer that if they do not have a deal by July 9th, that there would be an extension. So all of this could potentially bleed into the summer for a little bit longer.
Annmarie, with the latest in London. Annmarie, thank you. The attention of financial markets worldwide on the British capital this morning as the US and China get together. Here's the view on Wall Street. Keith Lerner of Truist writing the following: markets have proven more resilient than anticipated. We are upgrading equities from less attractive to neutral. Keith joins us now for more. Keith, welcome to the programme, sir. You're not alone. I've seen upgrades from Citi, from Barclays to price targets on the S&P 500. Keith, there is a belief from the likes of JPMorgan that the path of least resistance is still higher. Do you share that view?
Yeah, well, good morning. Great to be with you. Yeah, I think ultimately we will break to new highs eventually. I mean, Jonathan, as you remember, back in February, we had downgraded equities because we thought there was some complacency. You know, at the lows, the market was pricing in recession risk. We got more positive. And then on the rebound, you know, our work at the time suggested the risk reward was less favorable as recession risk was still relatively high. As our house view has changed to more of a muddle through, you know, that's why we've upgraded equities to really more of a neutral posture. But we do think there's some upside because it does show the economy has been relatively resilient once again, right? We've seen that time and time again over the last 5 years. And really, Jonathan, a couple of things changed in our work. One is the forward earning estimates for this market have started to inflect higher after moving down really since March. A lot of that is tech and communications related. So it's almost as if, Jonathan, that we were focusing on just one T, which is tariffs. Now technology is back into the forefront. I think the market is just, you know, dealing with the uncertainty around tariffs. It matters, but it's not the only thing that matters today.
Keith, you really highlighted it, this question of, is this economic resilience in the broad sense in the United States, or is this technological resilience when it comes to profit margins and the ability of big tech to keep getting some pretty incredible returns? Which is it? Which is the more dominant feature here going forward?
I think if you ask me over the next year, I think technology is still key. Listen, recession risk does matter, right? I mean, if you think about the market when it kind of bottomed, you know, the recession risk in the poly market was around 60%. Now that's down to 30%. So it's almost moving tick with that. So maybe the better answer is it matters both. We have to stay out of recession, and then the technology stocks need to continue to have those profit margins and move the overall earning estimates higher. Because when you look below market cap and you go beyond the large cap, you aren't seeing that same inflection in earnings in small caps, in mid caps, or even international markets. It's really driven by tech once again.
There's a question about whether the resilience of the U.S. economy pits the Fed not only against Donald Trump, but also against markets, where you have signs that, yes, the labor market is resilient, but it is certainly softening with a number of downward revisions that have a lot of people's concern. And there's a question of whether the Fed's going to remain on hold for not too long, but be de facto late to the game when it comes to how much the economy is decelerating. How much does that keep you up at night, kind of raise a headwind to some of the more bullish calls right now.
Yeah, that doesn't keep me up at night as much. I have a new puppy at home that's keeping me up at night a little bit more than the market as far as interest rates. No, see, listen, the interesting thing about the Fed is, I mean, they matter, but the market has been, pretty resilient. The economy has been resilient, both when the Fed was raising rates very aggressively. So it's almost as if it does matter that they need to kind of eventually start to cut rates, but whether they do it in September or later in the year, I don't know that's the main driver. I think the main driver still is more of, can we continue to push forward on some negotiations on the tariffs? Do the earning trends still stay somewhat resilient? Do the inflation trends continue to moderate? We still think, later this year, they're likely to cut rates 1 or 2 times. But, we're running out of runway short term as we move, into June. And now, as you mentioned earlier, these key deadlines in July, they're likely still going to be in a holding pattern. But I don't know that's the key driver in markets today.
Keith, you alluded to this just moments ago. Do you think we can sustain a forward multiple of 21 times?
I do. I mean, obviously, at that point, though, you are embedding some good risk. So part of the reasons why we're not on offense is that if you do have some disruptions, maybe some of these trade talks don't go as well as expected, something from left field in the summer months when there's less liquidity. I mean, there is a risk. But I think basically what the market is telling you is that this AI revolution is actually going to keep profit margins higher for longer. We still haven't seen it as much move to the 493 stocks. The other interesting point is when you look at this market, when you have pullbacks, like over the last decade, you keep bottoming at higher levels. Like we bottomed at a S&P forward PE of 19. That used to be the old peak. And then if we think about during COVID, we bottomed around 15 times. So it's interesting that each time the market pulls back, it's at a higher level. So I do think we can sustain this as long as the muddle through outlook that we have continues, and as long as that technology profits move forward, which is our baseline view. But at the same time, it's hard to say we're going to have an explosive move higher given our starting points, which are relatively rich today.
Well, we certainly had that already, a 20% move plus from the April 8th low. It's been vicious, and for a lot of people, it's been painful who have been caught on the wrong side of all of this, Keith. JPMorgan, I mentioned some of their views to you at the start of the conversation. They believe we could see a dual equity pain trade here, not just an equity market that keeps grinding higher, but leadership that might continue to narrow. Keith, do you think that could be the second pillar of the pain trade that could still emerge in the months to come, that broadening that people are looking for maybe just doesn't happen?
Yeah, well, we're still overweight, tech and communications. And I would say when I look at the overall technical position of the market, is only about 50% of stocks are above the 200-day moving average. So the S&P 500 is well above the 200-day moving average, but there's only about half the stocks in there. So I think that narrowing, likely makes sense. Is that growth rate? The interesting point, if we kind of zoom out a bit, yes, the market has moved up 20% off the lows. We all know, though, since after the election, the day after the election, the market is up 1%. And for technology as a whole, if you go back to July of last year, we're basically flat. So as much as we've had a lot of wide swings in the market back and forth, we really haven't gone much anywhere. And if you do break out of this trading range, that pain trade will likely continue. And I do expect that technology will continue to lead this. Technology and communications are two of our favorites as far as overweights right now.
Hey, Keith, enjoyed this. It was good to catch up, to kick off the trading week with you. Keith Lerner there of Truist on the latest and some of the bullishness out there. Hang Seng back in a bull market. Lisa, the S&P more than 20% from the April low.
Yeah, and you honed in on it. The idea of technology leading once again in that period of time. Yes, you've got the S&P up more than 20%, the bull market. You have technology, though, as a subsection up 33%. So it's definitely been led by big tech. People forgot, oh, yeah, the AI revolution is underway. They were revived of those ideas, given the fact that profit margins expanded. Question is your question about multiples and how much that changes on the backs of, guess what, bond yields and what we get with potentially the auctions as well as just generally the view on inflation going forward.
Mike Wilson of Morgan Stanley this morning. In 3 words, don't fight it. The equity market rally of the last few weeks. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the latest out of Los Angeles. California Governor Gavin Newsom is threatening to sue the Trump administration over the deployment of the National Guard to his state. Newsom describing it as an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in protests against immigration sweeps. Meanwhile, the U.S. and China are set to resume trade talks in London today following a phone call between leaders President Donald Trump and China's Xi Jinping. After reaching an understanding with Xi on resuming flows of critical minerals, Trump said he expected the London meeting to go very well. And we end with the latest on President Donald Trump's tax and spending bill. Senate Republicans appear to be shrugging off Elon Musk's criticism that the bill will add to the deficit. The Senate Finance Committee is expected to strip out some Medicaid and Medicare cuts from the House version that would have added to its cost savings. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. We'll have more on Tesla and Elon Musk a little bit later in the program. Up next, closing a deal with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed.
Up next on the program, we'll catch up with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Putting together a second week of gains on the S&P 500 through Friday's close this Monday morning. Good morning to you. Positive by 0.1% and just a few percentage points shy of all-time highs. Under surveillance this morning, closing a deal with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed, and it's going to be closed not with a bunch of staffers and bureaucratic language, but with handshakes. So that's the way President Trump operates.
Here's the latest this morning. The US and China resuming trade negotiations in London today. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer leading talks for the US. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, welcome back to the program. Let's talk about how this fits into the broader policy puzzle.
Yeah. Hey, John. Welcome back. Well, there's a lot of different objectives here at play when it comes to the administration's broader policy stance around tariffs. And you had Kevin Hassett even saying that at the moment, all their focus is on China. He amounted it to a laser beam, and perhaps that's taken away some of the focus from the other trade negotiations that are going on. But our analysts here at Bloomberg Economics do caution that there are a few different reasons to sort of temper the expectations ahead of today. And that's because there's a lot more complex policy issues that are really at the forefront of this conversation compared to the first round of talks in Geneva, where lowering tariffs to such a significant reduction was considered to be a pretty big win. Now, we did get some positive signs over the weekend. China's Commerce Ministry did say it approved a number of export licenses for rare earth related products. As you've been talking about, the U.S. has been accusing Beijing of essentially slow walking these critical and rare earth minerals that are so essential to U.S. supply chains. So we're going to have to see how this ultimately shakes out, because we do know that the administration would like to see some sort of forward progress here, since at the moment it's been pretty stalled. But at the end of the day, John, we're not expecting too big of announcements to come out of it, but it's really going to show us whether or not a de-escalation could hold.
Tyler, we talked a lot about the division internationally speaking. It's certainly the main event for financial markets this morning are the talks developing in London as they take place between the US and China. The main story in this country right now are developments on the West Coast in LA. What's the latest from the White House this morning?
Yeah. Hey, so, John, the White House is really trying to double down on its position that it sent in these National Guards to Los Angeles. And you even have Governor Gavin Newsom now saying that he's going to sue over the decision. It's really heightening an already fraught relationship between the administration and California's leadership. But you had President Trump this morning posting on Truth Social, doubling down, saying send in the troops. The L.A. police chief did say earlier that protests had started out peaceful, but conditions have really just worsened since then, becoming increasingly more violent. And also, we've seen some really stark instances of vandalism. At this point, these protests really do focus on the policy agenda when it comes to an increase in ICE immigration raids. That's really what ultimately spurred them. And, John, we are getting some new statistics from the agency. They say they've ramped up their deportation raids to 2,000 arrests per day. That is lower than the White House's daily goal of 3,000 per day. That's what they're trying to ramp up to.
Tyler, thank you. Appreciate the update. Tyler Kendall there in the nation's capital down in Washington, D.C. To build on some of that conversation, Terry Haines of Pangaea Policy. Terry, welcome back to the programme, sir. Let's build on the first point on trade. Developments in London and what we can expect over the next 2 days. Terry, what is the ultimate goal for these talks?
Good morning, John, and welcome back. The ultimate goals really are to have a couple of small wins. I mean, really what you had is you had the Geneva deal, which came down to a truce. Markets immediately jumped way over their skis and decided that was that meant Trump was standing back or chickening out or whatever. When they found out that that wasn't actually the case, there was a lot of chain pulling on both sides as the United States wants access to rare earths, China to chips and a bunch of other things, jet engines maybe, and all the rest. The goal here is to have some small wins, show forward progress, markets react positively. But that does not mean that there's going to be a bigger, more comprehensive trade deal either in London or anytime soon. It also doesn't mean the geopolitical backdrop changes any way or appreciably.
Terry, as John was mentioning, we're kind of on a split screen this morning. We have the talks in London very much driving market sentiment, potentially if there is some sort of truce that can ease the way to ongoing exports. There also is a focus in L.A. Could you put into perspective how unusual this whole situation is and what you're expecting in terms of how it really will ultimately come down to the court system yet again with Gavin Newsom threatening a lawsuit as soon as this morning?
Yeah, well, it's I'm sad to say it's really not that unusual. We've been through years, decades before in the 60s and the 90s, particularly, where there's been domestic unrest and combined with geopolitical tensions and trade tensions that the United States is heavily involved in and trying to deal with. So here we are at another one of these points, and at a difficult moment. Secondly, on the court stuff, I suspect Governor Newsom knows he's not likely to get serious rectification from the courts. I doubt he's looking at that, frankly. The courts are not about to interpose themselves and make themselves kind of Bigfoot the executive and make themselves the experts on what constitutes an emergency of any kind that justifies bringing in the National Guard. So, I don't think that's going to happen. And the president will be, I think, in the end, can do as he wishes here.
We've been talking about U.S.-China relationships and this question of where's the off-ramp. When it comes to the situation of one of the largest states in the country and the president and this question of a face-off there, where is the de-escalation, not just from some of the protests and the violence that we saw overnight, but also when it comes to the political tensions between the governor and between the president?
Well, I don't think you're going to get a de-escalation anytime soon. I don't think, I think the administration probably calibrates its responses to in future incidents based on what they're up to here. But they are and have been resolute about wanting to get their arms around illegal immigration. And you've got places like California that have held themselves out as sanctuary cities for years, which is essentially a challenge to existing United States law as it stands. So, there's a tension here, and that's going to get resolved by significant federal action. I think there's probably no doubt of that. And beyond that, I think you've got a situation where those, particularly in blue states and sanctuary cities and the like, places where other unrest might well happen, you're going to have a situation where there's going to be some federal presence as well, and that probably doesn't exclude even the nation's capital.
Terry, it's good to get your thoughts, as always. Terry Haines there of Pangaea Policy with the latest down in Washington, D.C. We were heading towards something like this, weren't we? We always were. Between California and the White House.
It was a war of words, and we knew that it was going to escalate. There was just a question of exactly how. Now you have a situation where Gavin Newsom is saying that this is unnecessarily exacerbating some of the violence, and then there are people looking at Waymo cars on fire and saying, what did the Waymo cars do? And this just sort of emboldens the federal presence, and you have this tit for tat at a time when ultimately it's going to come back to the court system, like so many different of these clashes have done.
If you are just tuning in, just joining us, welcome to the programme. Equity futures doing OK, just about unchanged. The main event in London, trade talks between the US and China. Up next on the programme, we'll catch up with Elizabeth Economy of the Hoover Institution ahead of another round of trade talks. From New York City this morning, good morning to you all. You're watching Bloomberg TV. Some bullishness on the south side after a 20% rally off the April low. We talked about JPMorgan saying the path of least resistance is still higher. Citi with a new price target, 6,300. Mike Wilson of Morgan Stanley saying don't fight it. Equity futures this morning just about positive on the S&P 500, mostly unchanged across the board here. On the Nasdaq, we're going absolutely nowhere. 3 hours away from the cash open. Let's get you some morning movers. Let's cross over to Danny Berger with more. Hey, Danny.
Hey, John. This might be one of the things weighing on the Nasdaq this morning. It is Tesla shares falling 2.5% after already falling some 15% last week. This time, the ignition for the fall is Baird. Strategists over there downgrading the stock to neutral from overweight, saying, one, the fundamentals aren't reflected in the price, so they're too far reflected. There's too much optimism in things like robo-taxi in the stock price, but also just saying that the Musk and Trump fallout, that spat injects uncertainty into the shares, which is, of course, why they fell last week, so lower this morning. Meanwhile, also to the downside, AppLovin and Robinhood. Now, these are two stocks that the expectation had been that they would be added to the S&P 500. That brings a lot of passive flows with it, so investors like to front run them. Well, bad news for them. After the market closed on Friday, we learned that S&P Dow Jones would be making no changes to the S&P 500. It is, of course, their discretion what gets added and what gets subtracted, so those shares both falling more than 5%. Finally, some also action late Friday. Trump signing an executive order to try to ignite the production of U.S. drones. There's also some safety measures also put in there trying to combat things like our adversaries flying drones in America. So with that incentive, you got a lot of the air mobility companies really rallying this morning. Archer Aviation, Joby Aviation, Vertical Aerospace, all of those gaining at least 8% this morning, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, our top story, the US and China looking to dial down the rhetoric. Representatives convening in London for trade talks with the focus on rare earth minerals and chip export curbs.
I think Terry Haines nailed it. It's unclear exactly what the motivation is on either side to come to some sort of comprehensive trade deal, certainly not during these talks in London. What is clear is that both countries are completely reliant on each other for specific things. China reliant on the United States for certain chips that are related to AI and all sorts of different technological expertise, and the U.S. to rare earth minerals. There are absolutely everything technological that we use, so it raises a question. How do you have strategic decoupling at a time where these two economies are intricately intertwined and dependent on one another for key resources? And that's the reason why people are looking for some sort of truce. What that leads to, still very unclear.
The trade data was really interesting overnight. Exports out of China to the US falling the most since 2020. Total exports still rising almost 5% from a year ago, slower than the 6% growth economists had expected. But the broader story, let's get into the broader story here. Look at exports to Vietnam from China, up 22%. When Secretary Besson sits down with the Chinese, Secretary Besson is making the argument that economists have made about China for years, if not the last decade or so, which is you need to rebalance away from foreign demand to internal demand, do something about domestic consumption. And based on the numbers we've seen out of China and that economy over the last several months, we've seen no sign of that rebalancing taking place.
Not only have you seen exports increase dramatically to certain countries, albeit declining pretty significantly to the United States, you've seen deflation, outright deflation in the country, which suggests actually the opposite, that personal consumption is not picking up in any kind of material way. And ultimately, China is leaning into the one engine that they've been able to rely on, which is production and manufacturing, and it has to go somewhere. You're right. And this has been a question, especially if China's going to be exporting to countries that are going to export to the United States, which has been what's been going on. How do you get some sort of coalition of countries to demand some kind of different practice where you don't just have different countries that act as intermediaries for China to then export to the U.S., to elsewhere? That's, I think, what's lacking. What is the overarching strategic plan to get some sort of coalition of countries together to really create a new structure that is feasible for all?
I remember when Larry Kudlow, the former National Economic Council director, used to talk about precisely the same thing. Europe has been reluctant to jump on board and get in line with the US for a long time, and I see little sign of that taking place as things stand this morning.
Yeah, there are even questions about the idea of a Chinese embassy so close to intelligence in London, because that would raise some questions about intelligence sharing with the U.S. Part of this is because Europe doesn't speak with one voice. They say they speak with one voice, but as we've had conversations with a number of the trade ministers, that's been a real issue, and I think will be ongoing.
Speak to Spain, you get a very different view on things. Speak to Italy, a very different view as well. I want to turn back to a big story here in the United States, a fourth day of anti-deportation protests in Los Angeles. President Trump deploying the National Guard sparking a feud with the governor. Newsom calling it an unlawful deployment.
And he did talk about potentially filing suit as soon as this morning, taking this back to even as high as the Supreme Court, ongoing questions around state rights versus federal rights. If you take a step back, it's important to realize that there are 1.8 million undocumented migrants in California. It's the biggest state harboring a lot of people who are not necessarily carrying legal status. And it raises a question about how far this government will be willing to go on the federal side and how far states are willing to go on the opposite side at a time where there's an increasing battle between Gavin Newsom and Donald Trump as they are seen somewhat as political adversaries.
Is it about policies or personalities?
Great question. I don't know.
That's always the issue, isn't it? We'll keep tracking the headlines for you and bring you any updates when we have them. Let's turn back to our top story for Wall Street. President Trump saying he expects talks between the US and China to go very well after his phone call with China's Xi just last week. Elizabeth Economy of the Hoover Institution joins us now for more. Elizabeth, welcome back to this program. It's always good to hear your thoughts on a very sensitive issue. There's a phrase that you've used, strategic decoupling. Can we begin with that phrase? What does that phrase mean to you? And ultimately, with that in mind, what's the purpose of these talks in London?
So I think strategic decoupling basically refers to the fact that both countries have identified the other as their most significant long-term strategic challenge, and each sees it as in its interest to begin to reduce its dependency on the other in terms of trade and investment. I think this is a process that's been underway certainly from the Chinese perspective for a number of years. We've seen with their Made in China 2025 program, right, the effort to reduce dependency across 10 critical cutting-edge areas of technology to ensure that Chinese companies dominate not only domestically but also become global champions. And I think beginning with the Biden administration in the post-COVID period, a sense that the United States is too reliant on China for a number of products, of goods that we need for our human security. That was the personal protective equipment, but also, as we see today, things like rare earth elements. And so I think that's the broader sort of strategic context for what we see taking place. In terms of what that means today, in terms of these discussions, I think the reason that we see the two sides coming together at this moment in the sort of middle or early stages of the 90-day pause on the tariffs is that we've seen from the Chinese perspective, the United States put export controls on the Huawei Ascend chips, on computer design software, and of course this big move on the visa revocations for Chinese students. So they view the United States as having not upheld the spirit of the sort of initial trade discussions that were held last month. From the U.S. perspective, of course, what we're concerned about in the moment is the sort of toughening export licenses on rare earth elements. The Chinese, it was our understanding that the Chinese would lift these licensing restrictions after the first set of negotiations. That didn't happen. And so that's why both sides are now at the table.
This certainly feels a lot more complicated than it did in the president's first term. In the president's first term, a lot of these issues could just be addressed with purchase agreements. We've heard them talk about those purchase agreements, but I just wonder this time in your mind whether you believe these can be addressed, can be pushed to one side with just a simple purchase agreement and a narrowing of the trade balance, or at least a commitment to do that.
Well, I think, we saw in terms of the president's first deal with the UK, that, in large part, that's what it amounted to. I think for China, of course, there are other issues tied to economic and national security that will continue to be irritants in the relationship. But I believe that for President Trump, that significant new purchases by the Chinese would at least go some way to addressing his concerns around the bilateral trade deficit, which is, of course, at least initially what impelled impelled this global sort of set of tariffs. So I think that they could make some progress if they were to announce, big new purchases. But I think you're right that it wouldn't solve what's really at the heart of the challenge here.
And Elizabeth, there's been this discussion around how much incentive China really has to make some sort of agreement, to come to some sort of resolution or have some sort of purchase arrangement with the United States, given the fact that President Xi Jinping seems to be doubling down in a pretty significant way and willing for the economy to slow as long as because there are certain strategic goals that are achieved over not necessarily the next year or two, but 10 years. How much do you feel like the leverage has shifted, that the desires have shifted here?
Yeah, I think it's a really important point. I think the United States miscalculated at the outset when it believed that we had so much more economic leverage over China because, as Secretary Bessent said, we import 5 times as much from China as China imports from the United States. But that ignored, I think, 2 things. Number one, that China has spent the past 8 years reducing its trade dependence on the United States. Since pre-COVID levels, the share of exports, global exports from China to the United States has reduced from 19% to 14%. And so I think that's one important element of it. The second is, as you suggested, in your discussion earlier, China has been routing exports to the United States through third countries, right? So it's still seeing, an ability, a path through to maintain its exports to the United States. And it ignored the fact that we have a greater sole source dependency on goods from China than China does from us. What that means is that for roughly 30% of the goods that we import from China, we have a 70% dependency or more on China. China doesn't face that same sole source dependency on a wide array of U.S. goods. So I think we miscalculated at the outset. China has been thinking strategically about how to reduce its dependence on the U.S. market, for 5 to 8 years, really since the first Trump administration. And so I think that the leverage has shifted over the past 5 to 7 years.
That said, Elizabeth, overnight we saw data that showed deflation for a 4th straight month in China. You have a price war with BYD that has gotten the attention of authorities in China, worried about cannibalization from their own market, and this idea that there's going to be a race to the bottom when it comes to electric vehicles, and really sort of undermining the perceived quality internationally. How much structurally, though, do they have a challenge that forces them to the table to ultimately come to some sort of even stopgap measure that could last a couple of years with the U.S.?
I think, look, China has been facing these challenges, the ones that you just suggested, for a couple of years now. This deflation issue is not actually new. The sort of incredible competition in many industries just within China, again, is not new. It's part of the process that they undergo every time they have this, overinvestment in certain industries. We saw it in solar panels and wind turbines. Now we're seeing it in EVs. We could see it in batteries moving forward. I think that's why we see the exports, right? And what China's doing now with the EVs is looking not just to the United States or to Europe, but they're looking to Africa, to Southeast Asia, to Latin America. They can export, very cheap cars there. They're looking to build manufacturing capacity in those countries. So China's looking globally, not simply at the wealthiest markets for their goods. And I think this is part of a long-term strategic plan. And I think they're trying to bet that, they can endure this short-term pain for a kind of longer period of strategic and economic gain. That being said, they have tried to do and take a number of actions over the past year to boost consumer confidence. They've had these massive goods trade-in programs. They've done things in the real estate market to encourage people to start buying property again. But overall, they're not willing to take the steps that are actually necessary, which is to move investment away from investment in technology, investment in military, into education and health. And into the pension system, so that people and consumers feel confident that they can spend because their other basic needs are being taken care of.
Elizabeth, you're one of the best, and it's good to get some time with you this morning. We appreciate it. Elizabeth Economy there of the Hoover Institution. Just that last part I think is so important. You followed this in Latin America as well. China for a long, long time has spent a lot of resources building up diplomatic relationships, not just in Latin America, but across Africa too.
Yeah, it was just shocking in Peru when I was down there in Lima. This idea that Xi Jinping came there to welcome the opening of a new port, and the streets were closed off and the Chinese flags were all over, and they were really making themselves known in every corporate corporate executives there said, money talks, and that's the reason why we have relationships with China. Where is the U.S.? And the U.S. was nowhere to be seen.
Trade talks kicking off between the U.S. and China in London, in the British capital. Annmarie will catch up with her again in about 15 minutes' time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yoder. Hey, Yoder.
Hi, John. Israeli forces intercepted a ship trying to reach Gaza that was carrying activists, including climate advocate Greta Thunberg. The group said in a statement that its vessel carrying aid was forcibly intercepted in international waters and that its crew was abducted and the cargo was confiscated. Meanwhile, Meta is in talks to make a multi-billion-dollar investment in artificial intelligence startup Scale AI. Sources telling us here at Bloomberg the investment could exceed $10 billion, which would make it Meta's largest external investment in AI yet. Scale AI provides data labeling services to help companies train machine learning models. And as Lisa just mentioned, a price war in China's electric vehicle industry is sending share prices tumbling and sparking intervention from the Chinese government. The industry is facing widespread demand weakness and extreme overcapacity. Authorities are trying to minimize the fallout, but prior attempts to intervene have had little success. That's your Bloomberg Brief. John?
Yoder, thank you. Thanks for the update. More from Yoder in the next hour. Up next on the program, rate cut bets looking challenged.
The direction of travel here will be in an environment where the Fed and the market are going to start to price in zero cuts for this year. Maybe towards the back half of 2026, they can cut one or two more times. The uncertainty is likely to fade to some extent.
Andrew Hollenhorst of Citi making a move. We'll get you an update on that in just a second. From New York City, this is Bloomberg. The economic data in focus this week. Important couple of days coming up in the middle of the week. Wednesday, Thursday. Wednesday, CPI. Thursday, PPI. Into all of that, equity futures just about unchanged to kick off the trading week. Equity futures on the S&P go nowhere. Likewise on the Nasdaq 100. Under surveillance this morning, rate cut bets are looking challenged.
The direction of travel here will be in an environment where the Fed and the market are going to start to price in zero cuts for this year. Maybe towards the back half of 2026, they can cut one or two more times. I'm surprised that the market is still looking for two cuts at this point. There's still the chance that the economy tips into recession as a result. The uncertainty is likely to fade to some extent. Our medium-term outlook is the economy should be fine.
So here's the latest this morning. Investors pushing back on rate cut bets. Andrew Hollenhorst of Citi pushing his Fed rate cut forecast to September from July, writing, "We continue to expect the Fed to cut policy rates more aggressively than what the market is pricing." Andrew joins us now for more. Andrew, good morning.
Morning.
Let's start with the timing. So you push back from June to July and now from July to September. What's not going your way?
The labor market data is what just hasn't given the Fed that clear signal that they need to be cutting. And I think that's what's difficult here is that we see the signs in various data that they will be cutting eventually, but when that time is that they're actually going to make that first cut, they're going to have to see the unemployment rate move higher. It rounded to 4.2%. That's going to be enough to keep them on hold.
So you've lost confidence on the timing, but maintained confidence on the degree to which we will get a response from them, which will be much more aggressive than the market is priced for. Why are you maintaining that confidence?
I think it's not that hard to get there if you look at things like the Fed Beige Book. Now, I know that the Fed is looking at the hard data. They're going to wait until they see that in the hard data. If you read the Fed Beige Book, it said the economy is contracting and employment was unchanged over the intermediate time period. So we're not hiring people. We have an economy that maybe contracting according to the Beige Book, at least slowing down significantly. Housing sector that's in contraction. So I think there's a lot of signs out there that we will see weaker data. You have to actually see that in the data, though, before the Fed's going to move.
It feels like a Rorschach test. It is so difficult to get your head around. Yesterday, the data came out, or on Friday, it feels like yesterday. The data came out, and it was better than expected. Yay, people are looking at this. Not a bad number in this. People take more time to look at it. Lots of bad numbers in this, in particular, the 2-month revision downward of 95,000. And the idea that the household survey lost over 600,000 jobs. There is this feeling that the economy, that the labor market is contracting, as you said. At what point do you think that it's going to be be evident enough in the data. Do you feel like that's coming soon, or do you feel like that's been what's been delayed?
I think that is what's been delayed. I think it is coming in the next few months. We know that this has been a very uncomfortable labor market where we've had a low hiring rate. We're starting to see in the weekly data, and that's what I would be watching here, continuing jobless claims. Those continuing jobless claims are starting to rise. So we don't have a big increase in initial jobless claims. People aren't being laid off from their jobs. But when people are out of work, they're finding it hard to get back into work. That's why the continuing claims are rising. That should mean the unemployment rate rises. We saw something very similar last summer. And if you remember September, we got that 50 basis point cut. So I think we're kind of in a similar dynamic to what we saw last year, probably a couple months before you get the Fed moving.
It also raises a question of which rate is more important to watch. We're talking about the Fed funds rate, the one rate that the Fed has control over, at the same time that there are real question marks over 10-year, over 30-year treasuries, the auctions that are coming up in the remainder of the week on Wednesday and Thursday. How much do you think that weaker growth infers lower rates substantially on the longer end, which is sort of key to stimulating the economy in any kind of real way in a downturn?
Yeah, so that's a new challenge for the Fed, that sometimes when we're getting weaker data now, we're seeing the equity market sell off, and usually you would think that would mean the Treasury market would rally and yields would move lower, but we've had this phenomenon where sometimes the Treasury market sells off and we actually get higher yields. And that's an issue for the Fed because we can have lower growth now and higher yields in the long end. I mentioned the housing market, mortgage rates that have stayed higher. You really need to see those mortgage rates come down, I think, to get the housing market expanding again. It is contracting now. And what can do that now is the Fed cutting rates. So it's just another reason that the Fed, I think, is going to have to cut. They're not going to look at that 10-year yield and say we're reacting directly to the 10-year yield, but indirectly they're going to see it in the data, and that's going to lead them to react.
Just a bit on Lisa's questioning, though. They did cut 100 basis points, and the long end sold off. So basically, they cut interest rates and mortgage rates went up. And there's a belief that when they did cut, they weren't committed to anchoring inflation expectations. So no surprise this time around. What are they all saying? The core of the Federal Reserve, every single speech, the chairman, over and over again, committed to anchoring inflation expectations, which raises the question about your ultimate call. Can they move fast and decisively to respond to a downturn in the economy and at the same time cover themselves about anchoring inflation expectations?
Yeah, it is a big challenge here, and it really depends on the measure of inflation expectations that you look at, how worried you are about those de-anchoring. If you look at University of Michigan survey, for instance, we've had a big move higher in the inflation expectations. Other surveys, not so much. I think what they need to do is really focus on the fundamentals here. And this focus on inflation, I think, is fighting the battle of 2 or 3 years ago. That was a time when the Fed thought that inflation was going to be transitory. It turned out to be persistent. We have now is house prices that are moving down. This is not an economy that is just too full of demand with supply constraints and you get really high inflation. That's what happened a couple of years ago. I think this is an economy where we actually have demand that's cooling. That means we're not going to get a lot of inflationary pressure. That means they can look through if we have a one-time price level increase.
Governor Waller's making a similar argument. It's a convincing one. How lonely is Governor Waller on the FOMC?
I think pretty lonely right now. I'd like to give him some company. I agree with the point that he's making. But again, I think that's why you have to see this so clearly in the activity data, which kind of means that the Fed is going to wait longer than they usually would before they cut, because they want this really clear signal from the labor market because they're worried about inflation.
They've talked about September. John Williams of the New York Fed has talked about September. I wonder if September is still too soon.
Well, it depends on the data and whether you get some sort of reflection there. I mean, Peter Scheer of Academy Securities was making the argument that if they really wanted to cut, they could have even looked at the non-farm payrolls report that we got on Friday and made an argument to cut. Right now, to Andrew's point, there is a fear that the runaway inflation that they failed to stave off immediately is going to be something that's repeated, and they don't want to do that. So they're going to have to lean into inflation. And Wednesday's CPI print is going to be really important on that front.
Things are super finely balanced. If NFP was bad on Friday, because the rest of the week's data wasn't great at all,
right.
NFP was bad on Friday, we'd be having a very different conversation this Monday morning.
Yeah, and probably President Trump would have more company with his 1 percentage point rate cut, rocket fuel to an otherwise pretty solid economy.
Andrew, it's good to see you. Thanks for the update. Andrew Hollenhorst there of Citi. Up next, Yoder of JPMorgan, former senior Trump trade advisor Kellyanne Shaw, Francisco Blanch of Bank of America, and Wei Li of BlackRock. From New York, the second hour of Bloomberg Surveillance, next.
The economy is going to be largely okay.
The economy slows, but doesn't tip over into recession.
What we're seeing is kind of just a natural maturation of the cycle.
The Fed's in a good spot here to wait and see.
The Fed, corporate America, everybody is kind of in this wait and see mode.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your price action, your scores are shaping up as follows. On the S&P 500, just about unchanged following a 20% rally off the April low. We're just 2.3% shy of all-time highs. Unchanged on the NASDAQ 100. We may not be unchanged later in the week. Your week ahead shaping up as follows. Look at this. CPI Wednesday, PPI Thursday. I'll throw two more things out there. 10-year debt auction Wednesday, 30-year supply on Thursday. It's going to be in focus big time for this market.
Yeah, especially because of the conversation we were just having with Andrew Hollenhorst. Is this time different than when we saw the Federal Reserve cut rates by a percentage point and the long end of the yield curve actually sold off? You saw yields rise. And this question of how much control does the Fed have and how much are they getting ahead of inflation expectations at a time where there still is a real debate. How inflationary will some of these tariffs be? Ultimately, we are going to get a read on whether there has been some sort of pass-through, and the expectation we'll see a little bit of it in CPI. But so many question marks remain about how this market is going to digest that amid a host of other trends that are happening in the underlying economy.
To give you a read on the south side at the moment, bullishness, seen tons of that over the last few days. I talked about JPMorgan, the path of least resistance is higher. Mike Wilson of Morgan Stanley this morning, don't fight it. He calls out I think a few words that you've been thinking about too. Near-term risk tied to guess what? Interest rates.
And that's the reason why people are watching the economic data. A lot of people, including Citigroup, upgrading their forecast for the S&P, and this is largely because of artificial intelligence and this memory that suddenly, oh yes, this was the revolution that was powering everything, and guess what? They just delivered really great earnings, and we've got positive earnings revisions. This is a good thing. On the bond market side, a real question of how much there could be a rally there too. That said, over the weekend, Morgan Stanley's Matthew Hornback came out and said that he actually expects within the next year 10-year yields to fall underneath 3.5%. There are a number of different strategists coming out and saying this time is different. RBC saying they would be cautiously adding after an NFP payrolls print on Friday that wasn't that great when you peek under the hood.
There's a man in the Treasury Department that hopes that Matt Hornback is right. I could tell you the man in the Treasury Department, Secretary Besant, is in London this morning. We'll catch up with Annmarie in just a moment. In London for trade talks with the Chinese. What is the ultimate goal of this round of trade talks with the Chinese delegation?
It seems when you take a step back, for the U.S. to get rare earth minerals, mainly magnets for certain high-tech elements, and for China to get access to chips. Right now, it's to just soften the ties to keep the two economies running. It doesn't seem like the goals are that much higher than that. It's almost going back to what they agreed to in Switzerland and saying, can we get back to that? A real question, though, of how this fits into some sort of larger negotiation at a time where the U.S. has come out and said they want strategic decoupling in these key areas that they cannot decouple because they still are so intricately intertwined.
It makes it difficult to make a deal in London this time around. We'll focus on those talks in just a moment. Equity futures positive by close to 0.1%. Coming up this hour, we'll catch up with Yoder of JPMorgan with stocks back near all-time highs. We'll speak to the former senior Trump trade advisor Kellyanne Shaw on trade talks in London, and Wei Li of BlackRock on the potential impact of trade uncertainty on global growth. We begin this hour with our top story. US-China trade talks in London with both sides looking to take down the temperature. Joining us now from London is Annmarie. AMH, can they take down the temperature? How easy will it be this time around?
Well, they're certainly going to try, Jonathan, and welcome back. It's nice to see you. Basically, this does look to seem to be an easier discussion given the fact that we did have that call between President Trump and Xi Jinping, which really broke the ice. What we want to see from these two, what they want to see in these discussions, is to go back to what they agreed upon just a month ago in Geneva. As Lisa just mentioned, for the United States, it's being able to get their hands on the critical minerals, the rare earths, the magnets used in things like mobile phones, high-tech industry, the defense industry, and they feel like those exports, those licenses have really been slow-rolled. We heard from Kevin Hassett over the weekend. He says they want to see a quicker pace about getting those goods and materials into the United States. When it comes to Beijing, this is going to be about potentially easing of restrictions when it comes to export controls on semiconductors, which, of course, is interesting because at these talks, who we didn't have in Geneva is Secretary Howard Lutnick. pick the individual at the Commerce Department who will decide whether or not and in charge of those export controls. So potentially this is a signal that for President Trump, that is on the table. So for both these economies, these are the two red lines and these are the choke points. Critical minerals for the United States, Jonathan, and chips for China.
Annmarie, how much is this just going back to the table saying, can we shake hands again and rewind the time frame to back in May versus offering some sweeteners, particularly on the U.S. side to China to get particularly those rare earth minerals flowing back into the United States?
Well, it's a great question because it does feel like what they're trying to do is at least get to the Geneva Agreement in principle, in actuality, in reality on the ground to make sure that they can get those export controls lifted for China and for the United States to make sure they can get those rare earths. I also think, given the fact that we did have this phone call between President Trump and Xi Jinping, potentially there could be another announcement on the call. We do know that President Xi Jinping invited Trump to come to China. Potentially, we can get discussions or read the tea leaves of maybe a meeting between these two leaders, and this discussion here in London can open that up. But overall, what is key to watch out for in this discussion is exactly what we watched out for a month ago, which makes it so difficult because it is red lines for both of these economies, especially for the United States. They want to make sure that China doesn't have access to the semiconductors and the chips. And that is China's big leverage when it comes to whether or not they're going to increase the pace of giving the United States those rare earths and magnets.
Annmarie, appreciate the update. Annmarie tracking the story for us out of the British capital in London this morning. Here's the view on Wall Street here in New York. Yoder of JPMorgan Global Wealth Management writing this. The longer tariff implementation gets pushed out, the more likely we'll have to raise S&P 25 EPS growth. The longer implementation gets pushed out, the greater likelihood corporate America can mitigate the tariff's impact. Abby joins us now for more. Abby, good morning.
Good morning.
How much of that have we already priced, given we've had a 20% move off the April low?
Well, so I think there are a couple of things, and when you were talking to Annmarie, I was thinking about this, because you were saying, is there this move to de-escalation, right? There isn't this thought process that they're going to go into these conversations and we're going to come out with a higher effective tariff rate, right? So I think that's important, right? The tail risk that was there when we had, Liberation Day and it was north of 25% implementation or effective tariff rate, that's kind of off the table, right? And this is becoming, as you mentioned, and in your conversation with Annmarie, a much more sector-specific conversation, right? And as the market starts to realize that, I think that becomes where you see more of a bull case. And I also think, look, there was a lot of de-risking heading into Liberation Day. I don't think, positioning is back where, near all-time highs. I think there's still a lot of length that can be added there.
So things are better than April, but they're worse than January. And
yes.
If they're worse than January, what's changed since the start of the year?
I think what has changed is, one, DeepSeek doesn't seem to be as big of a deal for the AI complex in the United States as it was originally thought, heading into earnings season, right? Like you mentioned earlier, we've seen really strong results this Q1, and guidance was really good, right? And I think the other thing is yes, the economic backdrop has changed, but also what we've heard from, let's say, outside of the AI complex in terms of earnings is that companies are really thinking about how to mitigate and how to work through what is actually a much more complicated backdrop, but we have to give them credit, right? The last 5 years were really, really difficult. 5 or 7 years, whatever it may be, has been really difficult, and there are levers that they can pull, and it seems like they're really doing that. And then you add on top of that the fact that, corporations are starting to really implement AI, which is from a revenue standpoint, an expense standpoint, is all positive from a margin story as well.
I just keep hearing in my head, the stock market is not the economy. The stock market is not the economy. And it feels like the divergence between the two is getting wider, especially as artificial intelligence is powering a lot of the optimism that we see with respect to the S&P 500 and certainly NASDAQ. How much is that ultimately your base case that you end up, to John's point earlier, with much narrower leadership going forward, an economy that's not doing great, but a U.S. stock market that can keep outperforming based on the performance of just a small handful of companies?
Yeah, I think that's the risk, right? If we think back a year ago, the concern from a lot of investors was this concentration risk. I could totally see that coming back into play, right? Because you do have this leadership. But I think, again, when we're thinking about like a year from now, what really drives like a more bullish scenario is, again, not just like the AI and tech companies that are implementing AI, but that it gets implemented across what would be the other sectors of the economy or the market, and therefore like, leading to revenue upside and expense savings across the board, which is a more bullish scenario.
If you end up with a pushing back of some of these tariffs at the same time that a U.S. economy is still strong enough to absorb some of these price increases, how much does that increase the inflation risk, actually? That a slow grind of tariffs that are implemented with companies that can adapt and adjust and consumers that can absorb it because they're getting paid lead to something that is more protracted and leads to a higher rate environment for a longer period of time?
Well, so I do think interest rates are the biggest risk, right? Like I think if you do see a material move from where it seems like the market can handle that 4.5%, but like if we see a meaningful and quick move higher, I think that would be, burdensome for the equity market from a valuation perspective. But I think like there isn't one option, right? There's not like companies are like, we have to pass on price, right? Depending on the size of the company and the supply chain logistics, like they can go to their suppliers, negotiate there, they can take some price and hit the margin a little bit. But if you're implementing AI, that kind of offsets that, right? So that's what we're talking about when we're thinking about all these different levers. And the longer that these companies have to think about those levers and implement them, the better outcome, I think, in terms from an earnings perspective.
On the equity side, I hear a lot of people worried about the prospect of higher interest rates.
Yeah.
I don't hear enough of the following, which is that the 30-year rate is still close to 5, and the data hasn't been great.
Yeah.
The data arguably doesn't justify 30-year yields near 5%. It looks like trend growth has dropped down from 2. It looks like the call for growth, at least for 25, has come down from 2.5 down to like 1, and maybe threatening to be even lower than that. Mm-hmm. Do you not look at that situation and equally say that's concerning, that we're hanging out at 5 on 30s and the data doesn't really justify it?
Absolutely. And I think especially also if you look at interest rate differentials, it doesn't suggest that it should be where it is. But I think that tells you there's a lot of term premium in interest rates and what we're looking at. And it isn't necessarily in control of the Fed on the longer end, right? That's why we're a little bit more positive in the belly and the shorter end of the curve, just because you can see that's going to be more influenced by the Fed. But I think what you're looking at the longer end is concerns around what's happening with the fiscal deficit, right? And I don't think that's really necessarily going away anytime soon. But the way that you longer term see that come down is, again, you see that productivity enhancement that therefore offsets that inflationary dynamic, and then you can probably start to see those rates come down.
How much is this, though, a challenge to sustaining a multiple of 21 times forward earnings?
I think interest rates are a big risk, and so the longer that they're high, right, the more restrictive it is. Like, remember when back in 2022, 2023, when we were talking about, Fed policy works with a lag? Like, that is definitely the case right now, and we're in a very different labor market as well. So I think that is the main risk, right, that you see them like hang out where they are now. But our view, we don't see them coming down materially, but we see the 10-year, at 4.3 at the end of the year. So that's some reprieve there.
Close to 4.50 right now. Abby, good to see you.
Good to see you.
Thanks for catching up with us. Abby Yoder there of JPMorgan Global Wealth Management. Yields this morning down about a basis point or 2. The focus will be on the long end of the yield curve later on this week, Wednesday, Thursday, 10s and 30s.
And it's quite a split screen when you get CPI and PPI, and then you get a 10-year and a 30-year Treasury auction. How related will they be to this idea that inflation is ticking up at a time when a lot of economists say it's very hard to understand how sticky that inflation really is going to be?
Equities ticking up this morning, close to a move of 0.1%. Thrilling stuff this Monday morning. Let's get you an update on stories elsewhere this morning, including an update on some big news from Warner Brothers in just a moment. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. We start with California Governor Gavin Newsom threatening to sue the Trump administration over the deployment of the National Guard, describing it as an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in protests against immigration sweeps. Meanwhile, the talks between the U.S. and China come as the latest data shows Chinese exports had their worst drop in more than 5 years. Shipments to America fell by 34%, despite the agreement reached in May that gave temporary tariff relief to imports from China. Overall, China's export growth slowed to 4.8% from a year ago, missing estimates. And on that news you just mentioned, John, Warner Brothers Discovery is splitting itself into 2 publicly traded companies. It will separate its HBO Max streaming service, movie studio, and TV production business from its cable networks. The move effectively undoes the Warner Media and Discovery Communications 2022 merger. Shares were halted earlier due to volatility, but will resume trading around 7:30. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. We'll be tracking that story for you throughout this morning. Up next on the program, diffusing tensions with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. I'm very comfortable that this deal is about to be closed.
Up next on the program, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw. Live from New York City this morning. Good morning. Live from New York City this morning. Good morning and welcome to the program. Equity futures just turning a little bit higher, up by 0.1% on the S&P. On the Nasdaq 100 this morning, just about unchanged. Under surveillance this morning, diffusing tensions with China.
President Trump, being a deal maker, talked with President Xi, and he said, let's take, our senior guys, the people who are the same level as you, let's have them meet somewhere, and let's get these things cleared up. We want the rare earths, the magnets that are crucial for cell phones and everything else to flow just as they did before the beginning of April. So I'm very comfortable that this deal is about to be closed. And it's going to be closed not with a bunch of staffers and bureaucratic language, but with handshake.
It's the latest this morning. The US and China holding trade talks in London. China's vice chair meeting with Treasury Secretary Scott Bessent, the Commerce Secretary Howard Lutnick, and Trade Representative Jamieson Greer. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, last time around these talks took place in Geneva, and there was a clear objective. Tariffs were just ridiculously high. They were close to 150%, and the president wanted to see them come down, China too, so they could have talks. What's the objective in London?
Yeah, hey, John. So there's a few different ones, but as Bloomberg Economics cautions, we should probably temper our expectations because, like you're saying, there's not that same sort of low-hanging fruit, such as lowering tariffs significantly, that would be considered to be a victory. We know both sides are going to be focused on export controls as these countries have put restrictions on products that are so essential to each other's supply chains, with China raising concerns about new AI chip curbs, for example, and the U.S., of course, wanting to see a speeding up of those export licenses when it comes to critical and rare earth minerals. So really the objective is going to be to try to keep the tensions down. We also can't forget in these conversations that fentanyl is also part of them. About 20% of the tariffs that are currently levied are tied to the U.S.'s concerns when it comes to that. The thing is that the White House really does have perhaps a bigger motivating factor here to try to get some sort of progress moved along, because the White House is hoping for a confluence of their economic policies to materialize over the summer. But the thing is that they put some pretty ambitious timelines on all of that, passing the reconciliation package by July 4th, the so-called reciprocal tariff negotiations with other trading partners by July 9th, and then China ultimately by the end or by perhaps the beginning of August. And John, as you well know, the last time that they negotiated under the first Trump administration, it took 18 months to ultimately get to a deal. But this time negotiators have only given themselves a 3-month reprieve.
Tyler, just quickly, do we expect some sort of announcement from this meeting that could be when President Trump plans to visit China?
Well, that's definitely something that we're going to be closely watching. It's something that this White House would like to see some sort of forward progress on this. As you well know, President Trump has said that he has accepted this invitation to go to China, and it's something that actually our reporting had indicated that they wanted to see happen in June. Of course, now, of course, that's likely not to happen as these tensions have really escalated and the trade tracks have gone a little bit off course than what was originally anticipated by this White House.
Tyler, with the latest in Washington. Tyler, thank you. To build on the conversation, the former senior Trump trade advisor, Kellyanne Shaw, joins us now for more. Kellyanne, welcome back to the programme. What went wrong after Geneva?
Yeah, good morning. Thanks so much for having me. I do agree that the focus of today's meetings in London is going to be about clarifying what was agreed in Geneva and figuring out a way to have the United States and China both feel like the other side is complying. Now, in terms of what may have happened, where the breakdown in communication was, there are two schools of thought. So, one school of thought is that when you're negotiating these things, sometimes there's a bit of constructive ambiguity. There's not quite that meeting of the minds that you might think there is. But we do have a document that was issued by the Chinese and U.S. government that says China will remove its countermeasures, which were imposed in retaliation for those April 2nd reciprocal tariffs and counter tariffs. And so the U.S. interpreted that as clearly not just the companies that were put on the UEL, but also the licensing for some of these rare earth magnets and critical minerals. And China's saying it didn't agree to that. So that's what today is about. It's about clarifying that. And I think that we'll have a final answer in just a few hours.
The personnel is slightly different. Last time around leading these talks from the US delegation side was Besson and Greer. This time it's Besson, Greer and Lutnick. How much would you read into the presence of the Commerce Secretary at this round of talks?
Yeah, well, clearly export controls are on the mind of not just the U.S. government, but also the Chinese government, who has been arguing that subsequent export controls issued by the United States about Huawei's Ascend chips, about energy products, EDA software, that those all also violate the Geneva Agreement. And so what I'm going to be watching for is to see whether or not the United States lifts some of those export controls in exchange for China complying with export licensing for critical minerals and rare earth magnets, or whether they don't. Because what is not sustainable is a commitment by the United States to never impose an export control involving a Chinese company or technology again. That is not going to be consistent with the direction that the president is going in terms of some of these more strategic and technical sectors. And so they're going to have to figure out a way forward, like what is going to derail future discussions versus what is not. The Commerce Secretary's presence, I do think, indicates that there may be some flexibility on the U.S. side, at least about some of these informed letters that were issued for energy and EDA.
You think that you have this sort of range of potential conflicts, and then it gets widened at every single step, it feels like. How much do student visa restrictions fit into this? How much do other kind of measures that the U.S. has taken since that Geneva Agreement also potentially weigh into these discussions?
Yeah, and there's nothing simple about the U.S.-China relationship, right? These are the two largest economies on Earth that have a number of challenges with one another that go far beyond economics and trade and involve national security and some of these other issues. Now, where I think the economic advisors on Trump's team are going to be is that we're here to talk about these economic and trade issues. I don't expect to see an announcement on the student visas, for example, but that said, for every action, there's an equal and opposite reaction. And if the U.S. or China begins to take steps that would seem to destabilize the détente, that is going to upset the trade talks. They're not immune from it. But I do think that the economic team will be focused on the economic issues.
As you know, these are nuanced issues. They're important but nuanced issues. The broader, bigger issue, I think, is an argument that Secretary Besson has made repeatedly now. Kellyanne, and you've lived a lot of this. They want the Chinese economy to rebalance. And I've heard economists over the last decade repeat that repeatedly. They would like to see the Chinese economy rebalance towards domestic consumption. In your experience, why has that been so difficult to get the Chinese policymaker to do just that?
Yeah, well, the trade between our two countries is significant. China is one of the top trading partners for the United States. And I think part of what you're seeing the administration argue is the reason for this imbalance has a lot to do with Chinese industrial policy, unfair trading practices, excess capacity, and some of these practices that just don't comport with fair market principles. And so to get this relationship rebalanced, they're also looking for China to make concessions on some of these issues that are a key part of its own economic model, which is very different than the U.S. economic model. And so these are challenges they're going to have to wade through. And I've said before, and I'll say again, nothing's going to get resolved in weeks. This is going to be years and years and years of negotiation. And I think those comments are about directionally where are we going, as opposed to an objective goal that's going to happen next month.
Kellyanne, appreciate the update, the reaction from you. Kellyanne Shaw there, the former senior Trump trade advisor. That overcapacity built in China, exported to the rest of the world, you pointed it out earlier on this morning, might be a problem for China too.
Well, they actually are pushing back against this with BYD cutting prices dramatically, trying to increase some of the demand at a time where demand's falling off a cliff, prices are going down, and China's getting the perception that they sell cheap goods that tend to be of lower quality, and that's what the Chinese government doesn't want to have happen.
Not in a good place. Hasn't been in a good place, that story, for quite a while. Up next on the programme, we'll catch up with Francisco Blanch of Bank of America as the oil market awaits US-China trade news. $7:30 stateside on the East Coast here in New York City. Equity futures positive by about 0.1% on the S&P 500. On the Nasdaq 100 this morning, totally unchanged. It's been that way over the last few hours or so. With 2 hours until the cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, some breaking news in the last hour. Warner Brothers will be splitting into two separate companies. Both of them are set to be publicly listed. It's going to do this by the middle of next year. On one side of the company, on one of the new companies, you're going to have its streaming and movie service. On the other side, you'll have its cable services, so things like CNN, for example. So shares moving 5%. Now, it's very volatile. They just opened after a trading halt, so around 5% higher. We'll watch this as it moves around. Now, to the downside, some other breaking news. This coming from reporting from the Wall Street Journal that Ken Moelis will be stepping down as CEO of Moelis. Only a little bit weaker on that news, down about 0.6%. It is likely that he will become the chairman after that on October 1st. They'll have some restructuring after that with personnel. One of the co-presidents set to become the CEO of Moelis. So those are the moves there. Meanwhile, Tesla also continues to trade lower in the pre-market session. Had a really tough week last week, down 15%, down another 2 1/3 this morning. This time, the kicker coming from Baird, downgrading the stock. It did have an overweight. That now goes to neutral, saying that for one, too much optimism around things like robo-taxi is priced in. And on the other side of things, that spat between Musk and Trump, that just injects uncertainty into the stock, and therefore you can't be overweight on it. John.
Danny, thank you. That name's down 2%. We'll get back to that spat in just a second. On our radar this morning, US-China trade talks in London, with both sides focusing on cooling tensions. The Treasury Secretary, Scott Bessent, Commerce Secretary, Howard Lutnick, and the Trade Representative, Jameson Greer, all meeting with their Chinese counterparts.
A key question about the urgency here and how long they have before you start to see some of the ramifications of this tit for tat in some of the products that people buy. There were reports that a manufacturing line shut down as a result of a lack of products like the rare earth minerals that do come from China over the past few weeks. A real interest in whether we could see some of the shelves go bare ahead of the back-to-school shopping season. A question of whether we've avoided that or not. And I think that that's actually really key to keep being parsing through in terms of the ramifications for the real economy as these talks do continue.
Personnel, key.
Yes.
I think we all noticed it. What is Lutnick doing there, the Commerce Secretary? We asked Kellyanne Shaw. Instantly responded and said export controls. Focus on that.
Yeah, and the idea that maybe it will require the U.S. backtracking from some of the export controls that have been put on, particularly with respect to semiconductors, in order to get China to export some of those rare earth minerals back to the U.S. so they can create some of those things like chips and phones and the like.
Annmarie on the ground, tracking some of those talks for us. We'll catch up with Annmarie in the next hour. I promise you an update on this. The Trump-Musk spat continuing. The president saying his former first buddy will face, quote, serious consequences if he funds Democrats who are running against Republicans who support his tax bill.
So this continues the tit for tat. You missed it, John. It was the explosion that stopped corporate America.
I was tracking it from a distance.
Yeah, you know, it's so funny. I heard all these reports about people who are trying to have serious corporate meetings. And somebody said, you know, did you see this X or did you see this truth? And all of a sudden, you know, that meeting ended. But it seems like there is this sort of tit for tat. Who has more leverage? It seems like President Trump had more leverage in this question of whether he could not expedite some of the regulatory frameworks for, say, autonomous driving. Right now, it's clear that the world's richest man also holds some leverage and that President Trump is a little concerned about what he could do with that stockpile of more than $300 billion of cash.
Can I just throw this out there? There was an element of this that felt somewhat manufactured last week. Did you not feel that way?
Some people speculated that this was Elon Musk trying to revive his image as politically independent and revive the image of Tesla. That was something that has been floated out there. But what did Dan Ives say? You don't burn the house down to meet the firefighter. So there was this element of how much is that valid? But you are correct. There is a speculation that maybe there is an element of perception.
Certainly elements of it felt that way in the last week or so. We'll return to this story, more on Tesla, in about 40 minutes' time. Want to get you an update on Apple. The Worldwide Developers Conference begins at 1 p.m. Eastern Time. The tech giant expected to unveil sweeping software changes and give updates about its struggling Apple Intelligence strategy.
I'm actually really interested in this, and not just because I bought a phone for a family member last night and saw what you could do with snapping for a long period of time and then identifying any particular item that you see out there, whether it be natural or whether it be a shoe.
You saw material improvement in the upgrade.
Yeah, if you can snap a picture and hold it down, and let's say someone loves your suit. They want to emulate Jonathan Ferro.
Can find out where to get it from.
They can figure out what it is.
Isn't Pinterest doing that already?
Well, okay, but it's more real time. If you want to figure out where this table was made or what product it is, you can snap that. You can do it with pretty much anything. There will be potentially other upgrades, and obviously you're not motivated to go out and buy a phone, so there is this question of what they can do at the WWDC that could potentially get you to want to buy a phone. It is important at a time where they have lagged behind the rest of the tech names. They're only up some 18, 19% since that April 8th nadir, so can they get some sort of sense that they are getting a competitive edge at a time where Samsung and others are already coming out with some new models?
The stock is down more than 18% so far in 2025. Typically, this is not the stock moving conference, not the stock moving event. Usually that's September and the unveil of the new iPhone. But this is the one, I think. It's about the software. It hasn't been about the hardware for quite a while, and the software updates just haven't been material enough to get people's attention.
The hardware, it's a phone. How much more can you do? It's going to zoom out and start going around your head? No, it's a phone. At this point, they have to give you some sort of application, aside from just writing your emails for you. They also can do that, which is actually kind of nice. So
you sound excited about recent developments, then.
Well, I actually am curious to explore some of what it can do. I want to understand how much I can outsource my life to another object so that I can have more time. I actually deeply welcome that trend.
You and me both. We're up 0.6% in the pre-market. Let's turn to commodities. Oil steadying after last week's 4% rally. Francisco Blanch of Bank of America writing the following: the oil market is poised to remain oversupplied, and we believe Brent crude may average 62 a barrel for the balance of the year. Macro tensions also mean that oil prices could temporarily sink to $50 a barrel. Francisco joins us now for more. Francisco, good morning. Good to see you.
Good morning. Thanks for having me.
Start with OPEC Plus, because I think that's been the main event for the crude market over the last several months. What's policy now, and what's the strategy behind it?
So you could make a case that OPEC is trying three things at once, right? It's trying to increase market share. I think it's more of a Saudi thing. You could argue there is a discipline element to what Saudi is doing, because it's really driven by Saudi Arabia. And the third bit of it is well, why now? Clearly, lower oil prices can help offset some of the upside pressure of inflation on U.S. tariffs. So let's say it's Trump administration pressure to get those barrels in. So I think maybe the three of them are objectives. But what's important about the strategy is that we believe this is not a price war that is going to be short and steep. Rather, it's going to be a price war that is going to be long and shallow. And it's going to be long and shallow for a couple different reasons. First, because in 2024, Saudi became a net borrower for the first time, whereas the shale patch is actually in pretty rude health from a debt perspective. They don't really issue that much debt anymore, and they can flex their muscle up and down depending on where prices are. But the shale patch themselves have their own issues, right? Because the higher tariffs are also bringing up costs. Remember, oil is steel on the ground, and steel is 50% more expensive than it was at the beginning of the year. So margins are coming in. Lower oil prices, higher steel costs. We are seeing a big drop in the rig count, and that's exactly what Saudi is trying to do. They have the lowest market share they've had in a very long time, not just against non-OPEC, but also even within OPEC, Saudi has lost market share. They've done this price support already by themselves pretty much for 3+ years, right? Having this huge shale response. They're done with that. They need to get, it hasn't really worked. $85, $90 oil, 6 million barrels a day of exports, not working. I mean, you want to get maybe lower prices with just more barrels.
Can we sit on that price war just a little bit longer? Yeah. They tried this about 10 years ago. I forget whether it was November 14 or November 15th. You remember the dates?
14.
14, yeah. OK.
Very
November
vivid.
2014. It's there in the memory somewhere. What's different about what they did then compared to what they're doing now?
Well, back then, what they were doing, it was a much deeper price war, but it ended up lasting longer than they hoped. And part of it is that back then, Again, the shale patch was very levered, so they had a lot of cash in the bank when they started the price war. And it was just at the beginning of shale, right? So we still have grown dramatically in the last 10 years. I mean, the U.S. has pretty much added 50% plus of the incremental oil and gas in the world for the last 15 years, right? So I think we are getting towards the end of the shale cycle, and tier 1 acreage is becoming more exhausted, and companies are pushing to tier 2 acreage, which is more expensive, and now you have this additional costs. So I think it's a different moment in time. And I, to be honest, I mean, I think, like I said, Saudis supported prices for a long time, and they've realized that just keeping them so high only means losing market share in the long run. So that's what's different. But also their own position is different. They want to build out the kingdom, and that's very important.
You talk about the war of attrition, and this idea that it's a long, drawn-out period of time where potentially you could see the $60 a barrel. At $60 a barrel, could you see the shale patch become a lot more productive, where you see rigs that are permanently taken offline, and it really becomes that much less profitable because ultimately it is much more expensive to drill there than, say, over in Saudi Arabia?
I think that's exactly what's going on, right? I mean, I think we're going to see slowing production here for oil. And in some ways, it's already happening. If you look at the rig count, if you look at marginal cost of production, many companies are facing oil in the 50s, in maybe as high as $60 a barrel. And therefore, this price range doesn't make things particularly appealing. Now, having said all that, these companies are cash cows. They're paying out huge dividends to shareholders in a world where interest rates are also high, which is the other big difference. Back then, we had 0 rates. Today, we have 5% rates. And shale's not a cheap operation when money is not free.
Yeah, and I'm looking right now, and in 2023, the U.S. oil and gas industry contributed about 8% to the U.S. GDP. So this isn't exactly a small part of the overall economy in the United States. I am wondering on a broader scale, we haven't even talked about supply on the demand side and whether demand is going to materially drop off to sort of add to some of these price declines. Based on what we've seen in the price of oil, how much is tied to the idea that demand is just declining, especially as trade really falls off?
So demand held up pretty well in the first quarter. We had relatively cold weather. And also remember, the first quarter, there was a lot of pent-up consumption because people were trying to rush in the imports, right? So we had actually a pickup in global trade in the first quarter. We've had a slowdown, of course, in the last couple of months. We'll see what the negotiations between the U.S. and China and other countries end up looking like. But I do think that, you raised a great point. $60 oil is also going to help demand in the medium term. Right? I mean, it just makes EVs less attractive. It makes a lot of energy sources less attractive. Remember, oil is the best energy source we got for a lot of reasons, right? In terms of its energy density, its flexibility, how easy it is to transport it, store it. And oil's cheap, $60 a barrel. I mean, it's $10 an MMBTU. It just, frankly, think about it, with all the inflation we've had for the last 10 years, right? So I think that also will encourage consumption. And ultimately, what I think Saudi's trying to do is saying, well, we don't want to run around with so much spare capacity because it's expensive to maintain. And we're also changing the way we consume energy domestically, which means our demand locally will go down because now we're going to use a lot more renewables domestically. So all of that, you put it together, you say, well, we have to get going and get this spare capacity into the market. And that's, I think that's really the plan. So you get more consumption, release your spare capacity, and maybe oil just doesn't do a lot in the next year.
Let's finish on something that's got more expensive. Gold. Yeah. 33.20, up by more than 26% now for the year. What's the call from you and the team?
So we think there's been a bit of a double top in the first half of the year. So we think maybe second half we need to see a real shock for prices to break away from where we are. And we have a $4,000 target, which we think may be a 2026 story. But if you look at the action in the precious metals, it's really coming from other areas. It's coming from platinum, which is really where things are starting to move in a big way. We've seen 1,200 hit this morning, and potentially we're going to go higher in platinum. We think platinum will trade well ahead of palladium, which is also being dragged along. And even silver. Silver is now 36 and change, and heading up to 40, we believe, right? So gold's had a good run. Now we're getting the rest of the precious metals, And then based on whether geopolitics and maybe the U.S. budget deficit situation worsens, then we'll have another leg up. But I think second half of the year might not be as great as the first has been for gold.
Francisco, appreciate the update. Thank you, sir. Francisco Blanch there of Bank of America. The depreciation of the US dollar tracked not against other currencies, but against precious metals. That's where you've seen these vicious moves. Outside of gold, as Francisco suggests, to places like platinum, etc.
Yeah, this is the bet that maybe there is some alternative to the dollar looking to diversify, and it turns out it doesn't seem like the currency's face is really providing that. I want to also just note this, following on what Francisco Blanch just said. Last week, the Baker Hughes crude oil rig count fell by another 9 rigs. It has fallen by 41 rigs in the past 6 weeks to the lowest level going back to October of 2021. Is this the goal, or is this just the side effect?
Honestly, it reminds me of 10 years ago, we used to track the rig count on Fridays.
I remember that.
Yeah, good times. We come back to that, aren't we?
I don't know. I mean, I don't think it's
guesses.
quite.
Do you remember rig count guesses on Twitter at the time?
It was a big deal. And it was like the junk bond market imploding and all the oil rigs.
Very different times. All right.
Times.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yohara. Hey, Yohara.
Hi, John. A U.S. trade team has extended its stay in India, signaling progress ahead of a July deadline for a tariff agreement. Sources say the team will now remain until Tuesday, tomorrow, to continue discussions originally scheduled for just 2 days last week. Negotiators are working on a phased trade deal, and we're told most of the issues may be finalized within a week. Meanwhile, Qualcomm is buying London-based semiconductor company Alphawave IP Group for about $2.4 billion cash. Alphawave makes high-speed semiconductor and connectivity technology that can be used for data centers and AI applications, 2 growth areas in the chip industry, of course, that are being driven by demand for products like OpenAI's ChatGPT. And the men's singles final at the French Open was one for the ages. After dropping the first 2 sets to world number 1 Jannik Sinner, defending champion Carlos Alcaraz survived 3 match points in the 3rd set. Alcaraz stormed back to take the next 3 sets and win the tournament for the 2nd straight year. The 5-hour and 29-minute match was the longest final ever in French Open history, and my eyes were glued to the screen. That's your Bloomberg brief. John?
Yohara, thank you. I don't know how you keep up that kind of intensity for more than 5 hours. I have to say, as a diehard Rafa fan, I never thought we'd get close to the kind of finals we saw between Rafa, Federer, Djokovic. These two, it's absolutely phenomenal. It's phenomenal.
What did they eat? I mean, seriously, how did they sort of regenerate during that period of time? 5 hours? That's like 2 meals and a walk and, going shopping. I mean, just think about it.
I'm tired after 3 hours of this and like 5 hours of that.
It's the same thing,
Goodness. Oh, yeah, it's so similar. Up next on the program, heading back to record highs.
The equity market is basically back to a high. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now, and we continuously use the word surprisingly. It's not surprising.
Up next, Wei Li of BlackRock from New York. This is Bloomberg. Equity futures just about positive on the S&P 500, up by close to 0.2%. The main event in London this morning, trade talks between the US and Chinese delegation. Kevin Hassett, the National Economic Council Director, speaking to a US broadcaster earlier on this morning, saying the meeting might be short but could bear results, expecting the Chinese to release minerals that the US needs and the US to release export controls if China talks go well. So that's how the stage is set this morning.
Trying to take away some of the pressure at a time where both countries still very much intricately intertwined.
The Chinese officials just arriving at those talks. US officials will follow, I imagine, in the next few minutes or so. Under surveillance this morning, heading back towards all-time highs.
The equity market is basically back to a high. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now, and we continuously use the word surprisingly. It's not surprising. The economy's doing fine. The consumer's doing fine.
Here's the latest this morning. Equity strategists raising expectations for U.S. stocks with the S&P 500 just 2.3% shy of all-time highs. Wei Li of BlackRock writing, we flipped back to being pro-risk in April once it became clear that hard economic rules limit how far US policy can move from the status quo. Wei Li joins us now for more. Wei, let's just get to those rules. What are those rules and what do they mean to you?
There are two immutable rules that we have identified that helped us govern risk-taking, even though there was a lot of uncertainty. Number one is if we're going to close trade deficit, then we cannot rely as much on foreign funding. So U.S. debt arithmetic is number one economic rule. The second economic rule is actually what you just talked about, this ongoing discussion around export control, around rare earths. It's really very much recognizing that if we're talking about rewiring global supply chains that took decades to build, we cannot do it from one day to the next. The grave consequences of trying to do that is not just higher inflation, but rather not having access to critical goods, not having stuff on the shelf. And these two immutable laws, economic rules, are the reason why we were able to put on more risk budget, even though back in the depth of April market lows, there was a huge amount of uncertainty in terms of policies.
Wei, it seems like people are getting more bullish on stocks and still uncertain about bonds, feeling like maybe the immutable economic law of supply chains and the desire to see companies continuing to be able to function with shelves that are full will trump just this idea of potentially some of the questions about inflation, as well as on the other side, that interconnectedness with the international investor. Does that remain the case, that as you've gotten more risk on, you've gotten more risk off with respect to bonds?
We have had this view for a while that we prefer U.S. equities, thinking the corporates a bit more exceptional versus U.S. long-duration government bonds. We have long argued that term premium needs to reprice to reflect the reality there is more persistent inflationary pressure because of structural forces, but also rising government debt that is expected to continue. So that being the case, we have seen some of that term premium repricing so far this year. But what's really abnormal is how low they were before, not the fact that they are starting to reprice, reflecting the fundamentals now. So currently, 10-year term premium is around 70 basis points. It went up as high as 90 basis points recently. We think that it could go to somewhere between 100 basis points, 125 basis points. So we definitely think that there is more to go. I would say, though, government bond and term premium repricing has been elevated to the level of Treasury losing safe haven status. That is too sensational in our view. The same applies for the dollar as well. You know, dollar repriced to fundamentals. It has been viewed as rich versus fundamentals for a while, but that repricing has been elevated to the level of dollar losing reserve currency status. I think that's too sensational. We have seen repricing to this type of magnitude in the past without their status being challenged. And in our view, right now, we're witnessing a fundamental repricing.
Well, as we get that repricing, just to finish, Lisa's question is an important one. Why don't you believe that your Treasury underweight compromises your pro-risk stance?
Because in addition to R, which is a very important factor in terms of valuing risk assets, we also have to care about G, which is growth. Because at the end of the day, risk assets is about discounting future cash flow. So R matters, but G matters just as much. And here the big picture is that growth is holding up just fine. You look at a very crude measure of Atlanta Fed nowcast GDP is somewhere between 3.7, 3.8%. You look at earnings, it's really holding up very well. At the beginning of this reporting season, consensus was looking at 8-9% year-on-year growth. We got 14%, right? Like corporate America, the micro story is very strong, which is why we believe risk assets can survive in an environment of high for longer in terms of rates.
And maybe even thrive. Maybe. Wei, we appreciate it. Wei Li there of BlackRock, thank you. Up next on the programme, Venu Krishna of Barclays, George Gianarikas of Canaccord Genuity, Claudia Sahm of New Century Advisors, and Michael Kushma of Morgan Stanley as we track the latest trade talks between the US and China out of London.
Market risks are a little bit elevated?
As investors, we have to trade this market.
The equity market is basically back to a high.
The market is going to need good news to continue moving higher.
In terms of the U.S. equity outlook, that's going to be about the earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with the attention of financial markets worldwide on this scene right here in London. The Chinese trade delegation arriving just moments ago, looking for someone to step out of that car from the US side in just a couple of seconds' time, with the National Economic Council Director Kevin Hassett setting the stage really in the last 30 minutes or so, speaking to a US broadcaster, saying the meeting today could be short but will bear results.
Yeah, basically a handshake that has the Chinese and the US sides coming together and saying, can we go back to that Switzerland moment where suddenly you were actually exporting rare earth minerals to the United States, and maybe some of the chip restrictions will get lifted from the US side, and that's the reason maybe why Howard Lutnick is there. A real question about how quick this will be, how easy this will be, and whether this sets the stage to a bigger talk.
So in Geneva, it was setting the stage for talks. In London, we're setting the stage for talks. Or is this a material policy change? What is this? What's the ultimate goal?
A lot of people feel like this is removing the immediate pressure of key supply chain necessities that both sides needs ahead of additional talks, with President Trump promising to go over to Beijing to meet with Xi Jinping. A real question about the incentive on both sides to come to some sort of larger goal at a time where both sides have talked about strategic decoupling. Hard to understand what the framework actually could be, aside from let's not torpedo each other right now with our economies.
When this meeting was announced, it helped stocks. When the last meeting was announced, it helped stocks. Stocks have been helped to a rally of more than 20% off the April lows. Do you need more than just a meeting being announced to help stocks?
You know, Abby Yoder nailed it of JPMorgan when she came on earlier, and she said the longer this goes on, the more companies can adapt. The more companies can figure out how to ameliorate some of their supply chain kinks in order to get ahead of whatever may be announced. Time is important. Even if it gets delayed, that itself is important for people who are looking at what Wei Li was talking about, the economic immutable rule, which is no country wants to absolutely destroy their industry by torpedoing their supply chains by a quick trying to unravel a complete system that has been put in place over decades.
Annmarie, tracking these talks in London. She joins us now. AMH, how different are these talks in Britain's capital compared to what we saw take place in Geneva only a few weeks back?
Well, they're pretty much the same, right? We're basically going back to square one in those talks with Geneva and really solidifying what the group agreed upon, both delegations, even though there seems to be some miscommunication when it comes to rare earths and obviously China's frustration with the export controls the U.S. has put on. Kevin Hassett recently speaking to the American media, Jonathan, the NEC director, talking about the fact that after there is this handshake deal, he does expect the licensing for the rare earth and magnets that are really critical for things like mobile phones, the defense sector, the high-tech sector will be flowing back into the United States at an advanced pace. And then he had something else to say. Any export controls from the United States will be eased. This is where I have a lot of questions. What kind of export controls is Kevin Hassett talking about? Is it the more recent ones that we've seen since the Geneva talks, or ones that were put in place prior to Geneva, like the H20 NVIDIA chips? These are the questions and the details we are going to really want to make sure we understand coming out of these talks. Kevin Hassett saying it's going to be a handshake, but really the devil's going to be in the details.
And then what? And that's the important question, Annmarie. And then what? Where do they go from there once they've agreed to that? Which, let's face it, based on the comments from Kevin Hassett earlier on this morning, it looks like that's already been agreed to.
Right. This looks like it's been agreed to. And you kind of got a sense of that when the president put out his statement after Xi Jinping spoke with him on the phone. And we just saw Ambassador Greer there arriving at the talks, followed by Commerce Secretary Howard Lutnick. We should note he is a new addition to this, which is why everyone is focused on the export controls. It does look like the president is really putting that on the table with the addition of Howard Lutnick, part of the personnel in the delegation. Where do we go from here? Obviously, everyone everyone is speculating on a potential meeting in person between Xi Jinping and President Trump. President Trump said that this was discussed on the call. Maybe he would go to Beijing. There was also an offer for Xi Jinping to come to the United States. And then, of course, there's the question of whether or not there's going to be this grand bargain, a massive deal between China and the United States. When I caught up with the Treasury Secretary a few months ago and we talked about this high tariff rate on China and what the direction of travel was, and you can see Secretary Bessent there arriving now in central London for these talks. He's really the driving force behind this delegation. When I spoke to him, he said we don't necessarily need to decouple, and he said there's a grand deal to be had, but potentially, how long is that going to take?
Annmarie, stay close. The scene is set and the individuals are in the right place at the right time to have those conversations. Annmarie, thank you. Just saw pictures there, live pictures from the City of London. In London, a conversation between the US and China. The Chinese delegation arriving about 20 minutes ago. The US delegation arriving just moments ago. The Trade Representative Jamieson Greer alongside the Commerce Secretary Howard Lutnick. And then at the very end there, the Treasury Secretary Scott Bessent. And we're told going into these talks, they will be short, but they will bear results.
And this ultimately will probably have to do with the red lines on both sides. Annmarie nailed it, though, and she said the more interesting thing is which chip restrictions could potentially be lifted in the United States, given that this has been a bipartisan effort and long-lasting effort to try to not export the most advanced chips to China.
Equities rallied into the weekend on the announcement of the talks this morning, up by 1/10 or 0.2%. Let's keep it on Wall Street. Here's the view on Wall Street this morning. Stock steady as traders await the latest round of trade talks. Venu Krishna of Barclays writing, we recently increased our year-end price target on the S&P to 60.50 from 5,900, expecting some valuation upside from clearing peak trade policy uncertainty while remaining wary around the tariff drag. Venu joins us now for more. Venu, good morning.
Good morning.
That peak uncertainty, it's behind us. That feels really stale to me now, and I've read that in so many different reports over the last week or so. How stale is that call now?
I think what it boils down to what you mean by peak uncertainty, and I think what we have got used to is when we were ratcheting up tariffs 100%, 150% and more, that's really shook up the whole world, saying where is the end to this? Now, I think there's a general understanding that this is broadly a negotiating approach and that we will eventually settle at a level which is different than this, where it is unclear. So that's what I mean. So I think the market has got also, to some extent, I would say, desensitized to the daily gyrations in the numbers. But I think in our view, the reality is that tariffs are here to stay. The only thing we're debating is what's the magnitude and in what form is it actually unleashed onto markets.
Do we have a sense, though, of what the economic ramifications will be? Because right now we're seeing economic data that has been largely surprising to the upside. We saw non-farm payrolls demonstrate that the labor market is holding in. If it doesn't cause more damage in the economy, why aren't you even at a higher level when it comes to your S&P forward projection?
The reason is quite simple. In the beginning of the year, we were estimating the impact, but we were not actually including it in our estimates. Now, the reality is that it hasn't happened yet. It doesn't mean it won't. So companies are struggling. If you saw, even after a very strong Q1 earnings, there's a lot of talk about raising prices, taking hit on margins, trying to put costs onto their supply chains, trying to continue to diversify away from China. And most importantly, you saw massive pickup in inventories, which led to a Q1 negative growth rate in the US. So the point is, you're just not seen it yet. It's going to happen. In fact, it's an interesting question you ask. One of the things we did along with our upgrade recently is to provide investors a detailed grid by country, by base level of tariffs, and then trying to estimate the dollar impact on any combination you want to pick, right? And so right now, my estimate hasn't changed. We cut it down by almost $10 from the beginning of the year. All that is because of tariffs. And now it's the same, and we are assuming 30% incremental on China and 10% the rest of the world. It may not pan out that way, but that combination leads you to a hit. It's going to come.
What's fascinating to me is when we talk to people who come around this table, they acknowledge all of these things. They say the tariffs are here and you're going to see some sort of hit. You might also see a bit of an inflationary feel that will keep rates elevated. At the same time, it's not even about the real economy. It's about artificial intelligence. It's about the big tech players that have been driving all of this. The narrow leadership's going to continue, and it almost doesn't matter. It's sort of the classic, the economy is not the stock market. How much can you get behind that?
I think we are behind that, absolutely. So one of the things I feel very comfortable, I think we talked about it in the past, is the strength of big tech, right? 6 stocks, ultimately, and you talked about it, the fulcrum of the market, they are continuing to power on. If you looked at this rate at which they beat their earnings, it was the highest in more than 3 years, which is what happened in Q1. And that was the sector which saw the biggest de-rating in the market. So I think the base of the market, which is almost tech is 40% of the market, is very solid. And the rest of the market is trying to grapple with tariffs with various levels of uncertainty, and you're going to feel that. So when you put everything together, I think growth is moderating, inflation is somewhat sticky, consumption also has been not the most robust, but relatively strong. But when you bring it all together, I think earnings are okay.
Do you think tech can behave defensively in an economic deceleration? Do you think tech stocks can behave defensively?
Depends the scale of deceleration. I think if you have a shallow recession, then tech will be fine. But if you have a deep recession, tech will not be immune.
All bets are off.
Yeah, I think the biggest thing with tech is not to do even earnings. I'm quite comfortable with their earnings, how they're going to deliver. It's a multiple you pay. It is the highest multiple universe within S&P. It's trading at around 27 times roughly. The rest of S&P is trading at a shade under 20. So it's a massive difference. Partly explained by the strength and quality of their earnings growth, but to the extent that there's a catalyst for a de-rating, like we saw just in the last 2 months. I mean, tech de-rated by more than 30%, and nothing changed in terms of the earnings practically compared to the rest of the market. So, I'm more comfortable on their earnings, but I'm always wary about the multiple you pay for that.
Let's finish on the multiple. This has been a theme for us this morning. So the index is trading at 21 forward earnings on the S&P 500. How much confidence do you have that we can sustain an elevated multiple like that one?
I think you can sustain to the extent that earnings are relatively resilient, right? And the numbers we have, if we deliver, I think the market will bear that. More importantly, I think to your point earlier about it being stale, about tariff peak uncertainty, I think, and that's what we are doing, I'm looking past this year. I'm saying, by the end of this year, on the tariff front, we will settle somewhere, right? Let's say 30-10. It is what it is, and companies are trying to deal with it. What will a normalized world look like in 2026, in which growth is reasonable but moderating, inflation is somewhat sticky, consumption is okay but not as strong as before COVID, right? And that leads you to an earnings number which by our estimate will be 9% up compared to this year. Consensus, of course, much higher than that, but that's relatively strong.
We might have a very distorted view of what normal is by the time we get to 2026. Do you know what normal is anymore?
Stop asking me difficult questions.
Baseline tariff at 10% now is normal.
No, nothing is normal. I don't understand how we can wrap our head around anything. We're having the X versus truth battle royale. It's the most expensive pay-per-view battle we've ever seen, and we have question marks about who friends are. I mean, normal, come on. Why ask these questions on a Monday morning?
2026 just feels like a lifetime away, although 2025 is rapidly passing us by. Venu, it's good to see you. Thanks for the update.
Thank you.
Appreciate it, sir, as always. Venu Krishna there of Barclays. Equities on the S&P 500 positive here by 1/10%. The talks have started in London. The two delegations have arrived, both on the US and the Chinese side, and we'll be tracking those talks as they commence. And whenever we get updates, Annmarie is going to be on the ground for us, and we'll catch up with her again in about 30 minutes' time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara Anand. Hey, Yahara.
Hi, John. California Governor Gavin Newsom is ratcheting up his fight with President Trump. Newsom is now threatening to sue the administration over the deployment of the National Guard, calling it an unconstitutional act. The president deployed more than 2,000 troops to Los Angeles over the weekend to intervene in the protests against immigration sweeps. Meanwhile, the world's largest retailer, Walmart, is making a renewed push into financial services. Sources telling us here at Bloomberg that Walmart's backed fintech firm OnePay picked Synchrony Financial to issue a co-branded card that can be used outside Walmart, as well as another available for purchases just at the retailer. They'll be available in the U.S. later this year. And a check on Warner Brothers Discovery. Shares are rising nearly 9% after it announced it's splitting itself into two publicly traded companies. It will turn its cable networks, including CNN, into one company. Meanwhile, its streaming and studio business into another. The move effectively undoes the Warner Media and Discovery Communications merger back in 2022. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the Morning Calls, plus George Gianarikas of Canaccord Genuity on what's next for Tesla and the feud between Elon Musk and the President, Donald Trump. From New York City, this is Bloomberg. Trade talks in London underway and in focus between the US and China. They've just commenced just moments ago, both delegations arriving. Going into the opening bell, equities are looking like this. Futures positive by 1/10%, coming off 2 weeks of gains on the S&P 500, a 20% plus rally off the April low, and now just 2.3% shy of all-time highs. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Lulu to equal weight, expecting tariffs to weigh on margins through the first half of next year. Your second call from Citi, raising its price target on Broadcom to 285, citing the company's growth outlook for its AI business. That stock is up by about 1/10%. And your third and final call from Baird, downgrading Tesla to neutral, saying the feud between Elon Musk and President Trump adds, quote, considerable uncertainty. The name is down another 1.8% this morning. Let's stick with Tesla. The feud between the two leaders continuing. The president saying he has no intention of speaking to Musk after Thursday's public spat, which cost Tesla $153 billion in market value. Joining us now is George Gianarikas of Canaccord, who has a buy rating on the shares and a 303 price target. George, welcome back to the program, sir. Let's start with the feud. Ultimately, it got out of control last week. What does it mean for this company operationally and how this stock trades?
Well, look, Q1 was a little bit of a tricky quarter to discern how much Mr. Musk's political contributions have had an impact on company fundamentals. Q2, just based on the publicly available data, is not trending very well, but we try to look forward, right? And so there are three very, very important things for the company this year. Number one, it's promised a couple new vehicles. We'll see by the end of the year what they launch. Number two, they have a very, very, very important launch this week in Austin, Texas with Robotaxi. And number three, longer term, there's Optimus, the robots. And we'll have to wait a couple of years as to what the impact on the P&L is. But we try to focus on the fundamentals of the company. And, you know, we're looking forward to understanding how these three catalysts can impact the stock.
Well, let's pick out one element, one dimension of that story then, the robo-taxi business. So I mentioned the downgrade that came from Ben Callow of Baird just moments ago, and it was more on the robo-taxi business. He said that Musk's comments regarding the robo-taxi ramp rate are a bit too optimistic, and we believe this excitement has been priced into shares. So that's one opinion. I'd love to hear yours, George. What's your view on that side of the business?
Well, Ben is a good friend of mine and really smart. The way we look at autonomy is that it's, number one, incredibly important for the world and for our country. And if you look at what Tesla's trying to do, they have a singular approach to the market. They're using only cameras and they're using end-to-end AI. It's a different approach. And so this catalyst in June, this week, is incredibly important. But if you look 1 to 2 years out, there are only a few companies that will be successful in bringing robo-taxis to market or autonomy to market, in our opinion. That likely includes Tesla, likely includes Waymo, likely includes Aurora, a company that we cover that's focused on trucks, and it likely includes Mobileye. So these are incredibly important markets, not just for the world, but for our country. To the extent we need to compete against China, we need to make sure we have a flourishing autonomous market. And if you want to bet on a company in that space, well, Tesla's a very good bet, in our opinion.
George, one of the bull cases was that Musk's close relationship with Donald Trump would allow the regulatory framework to get this going faster, that you would end up with a quicker autonomous vehicle rollout than otherwise would happen. Now there's this question of whether that kind of rollout will be hampered by this ongoing feud. Why do you shrug that off as a possibility at a time where potentially that was something that's been floated by people close to the administration?
Yeah, I'd like to think that our country is beyond crony capitalism. And to the extent you think this is a very important market and a very important technology, which we certainly do, we have to look past that. And we need a set of federal rules that will make the glide path easier for companies trying to compete in the space. And that's what the administration has promised. I think it'll happen. And to the extent Tesla has a successful launch this week, which we think it will, it'll lead forward to multiple companies competing in the space that I just mentioned, whether it's Waymo, whether it's Mobileye empowering OEMs. And like I said, we need this technology for a more sustainable world, for the multiple benefits it will bring to our country.
You mentioned China and competing there, and that's an element of Tesla's story also that's been called into question, especially over the past couple of months, as there's been this race to the bottom when it comes to pricing of BYD and cars in China, electric vehicles in particular. How do you factor that into the outlook for a company that is sort of playing this fraught relationship in a very delicate dance?
Well, to be clear, like you said, China is incredibly important to Tesla. It's about a quarter of its sales, and they've been very successful there. This quarter, just the publicly available data suggests that the momentum might be stalling a little bit, but they have additional vehicles that they'll launch there. And like a very important point for our country and for Western markets is that if you look at it strategically, China is well ahead. And there are only a couple of companies that are successful in the West in making compelling EVs. That includes Tesla, that includes Rivian. And we need these markets to flourish in the West. So to the extent we need Tesla to be successful, we think they will be. They have an incredible tech advantage, regardless of what the Chinese have done, in our opinion. So we need this company to flourish, and we think it will. We're looking forward, right? They have a very compelling Model Y. They have other vehicles that they've promised. They have a potential scale advantage in autonomy because they'll be able to enable many of their vehicles with just a software upgrade, And it's a singular company to that extent because the others need additional equipment. So if they're successful in that approach, they can enable millions of vehicles at the same time to become robo-taxis. It's pretty phenomenal.
George, appreciate the view and the opinion, the update from you this morning. Thank you, sir. George Gianarikas there of Canaccord Genuity on Tesla, and remaining constructive when others are downgrading the name.
Yeah, talking about the autonomous vehicle and the rollout of a robo-taxi this week, it is going to be really important. And hopefully we can get to a place where you can call up a car for your kid or for your elder parent and not have to worry about them possibly driving because it might petrify.
Feels personal.
It just feels so deeply personal, the idea of being scared for your child or your elder parent and what are they going to do, and I don't want to have to drive them, and being able to sort of call up something that might be cheaper, reliable, get them somewhere is kind of an exciting idea.
Seen the Liberals are burning Waymos too now, not just Teslas.
Look, I think that a lot of people are looking at what's going on in Los Angeles.
You didn't have to respond to that. I was
okay,
just throwing a grenade in there.
Out there.
I was just throwing a grenade in there.
Trying to see what happens.
And then you took the bait.
Well, I mean, come on. Like, what do you expect from me? That's what this is. It's a talk show, It's sort of you trying to get
back and forth.
Look, what am I supposed to say?
Waymo's gone
very. I just sit here quietly.
Just a joke, all right? If you are tuning in for real news, all right, and that is real news, by the way. China and the US sitting down for talks. Those talks are underway in London. The delegations arrived about 30 minutes ago. And I have to say, based on the comments we've had from the administration, the White House already this morning, they've set the bar really low for these talks. Expectations are now like, this is going to happen. We're going to get some kind of agreement and move on from here.
And they're setting it low because what else can they accomplish? It's unclear exactly whether they want to get some sort of larger framework together. They just want to get their rare earth minerals. They just want to get their magnets. And on the other side, they just want to get their chips. And it sounds so easy, but these are the red lines. And so this really raises a question about how easy this will really be to cross this particular Rubicon.
These are the hard red lines, and this is just the beginning. We've had the Geneva round of talks. We've had the London round of talks. You'll have to pick another capital in a few months' time to continue this, that's for sure. Next on the programme, we'll catch up with Claudia Sahm of New Century Advisors, looking ahead to a busy week of data, including CPI on Wednesday, PPI on Thursday. From New York, you're watching Bloomberg TV. It is June 9th, April 8th. 2 months ago, they were the lows. 20% rally off the low since then on the S&P 500, 20% plus. And we add some more weight to it this morning, up another 0.2% on the S&P 500. With an hour, 60 minutes to go until the cash open. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Moving to the upside this morning, Warner Brothers Discovery announcing that they would be splitting into two different companies. One, its streaming service. The other one, its cable TV service. Those shares up 8.5%. The hope is unlock some of the value, some of the premium of their streaming offering, considering it's been hard to really post profitability numbers as more people migrate away from pay for TV. So that's Warner Brothers Discovery. Also on the move this morning, Merck publishing the results of its cholesterol drug study, having positive results in 2 dual trials of its late-stage trial. Those shares up 2.3%. The hope is offer this drug that helps lower cholesterol to the same efficacy as an injection form of this drug. So some hope there. Finally, rounding things off this morning, some Bloomberg News exclusive reporting that Walmart has chosen Synchrony Financial to be a partner to issue its credit card. Now, it had used Capital One. Before that, it did use Synchrony. It's come back around to it for the first time since 2018. So those shares up 3%, but also just represents a doubling down of Walmart on their financial services offering, something that the traditional firms have been closely watching, John.
Danny, thanks for the update. Appreciate the hard work. 3 names plus 1 to look ahead to before the opening bell. Hitting the ground running this week off the back of the payrolls data on Friday. We're looking ahead to CPI and PPI data later this week. Mike McKee has more for you. Good morning, Mike.
Good morning, John. Well, we've got troops in L.A., we've got big talks going on in London, and everybody is asking the question on social media, when are the markets going to even notice? You were talking about how they keep going up. Perhaps Wednesday. CPI is going to be a big day for the markets. The first time when we're expected to see a real tariff impact. CPI expected to rise the first time in many months. And that is going to be something to watch closely, because then it's followed by PPI, also expected to rise. Is inflation actually on its way? We start today with the New York Fed's inflation expectation numbers. Going to be interesting because they have been much lower than the University of Michigan numbers. And the Fed's been pointing to that and saying, well, even if people are saying inflation is going to go up, we're still under control. Well, we get the Michigan numbers on Friday. And then looking ahead, we're going to set you up for the summer here. Coming up in 2 weeks. A little less than 2 weeks now, we've got the Fed meeting. They're not expected to do anything, but we get the new SEP and the new dot plot. Are they going to have any validity? June 24th, Jay Powell goes up to the Hill. Humphrey Hawkins' testimony. That will get a lot of attention. And then July 8th, the 90-day tariff pause ends. Another Fed meeting on July 30th. And August 10th, the China pause ends. So a lot of things that could affect the markets are still out there, even if so far everyone's sanguine.
It's quite a calendar, Mike, and thank you for bringing that to the programme. It's a calendar that this Federal Reserve is at the mercy of. And I wonder, as we sit here in the blackout period, the quiet period ahead of that Fed decision on Wednesday, Mike, I wonder if we have a decent understanding of how they'd respond to upside surprises on CPI if we do get them in the coming months.
Well, it depends on how far and how fast it happens, John. If the CPI goes up, as it's expected to do by 0.1% this last month, then the Fed is going to say, OK, we expected that, and that's not a reason to do anything about interest rates because we feel we're tight right now, and just where we are at the moment is enough to put pressure on inflation. But if it goes up 2-3 tenths or whatever by September, then they could be worried and they could start hinting about rate increases.
Mike McKee with the latest. Mike, thank you. Let's focus on this story. Claudia Sahm of New Century Advisors writing the following. As early signs emerge that tariffs will drive up prices, the Fed faces a crucial question. Will tariff-induced inflation be short-lived, or will it persist? Claudia joins us now for more. Claudia, welcome back. As always, we could spend some time with you talking about the US economy right now. Let's get to that first line, that first piece of that sentence. As early signs emerge that tariffs will drive up prices, what are you focused on right now? Where do you see that at the moment?
Right. Well, the first place we're going to be looking for it, and we ought to see more of it this week, is in the goods prices. And that is both on consumer-facing prices, and we're also looking in the producer prices. I mean, we are tariffing intermediate goods as well, and that will eventually have some impact on consumer prices. So it's looking at the data, and again, as was said before, these magnitudes will matter, and how long we see this uptick in prices.
So, Claudia, that gets to the next question: short-lived, or will it persist? How instructive is the labour market with that in mind? When we start to think about that, how much of a guide can we take from where the labour market is currently?
Right. Well, the labor market is important. It is holding up. We saw modest signs of cooling, but not a dramatic, weakening. When you talk to businesses, one of their first priorities when they think about pricing is consumer demand. I mean, it is the case the labor market holds up. It may be an opportunity for businesses to pass more of these tariff costs on to consumers in terms of prices. I mean, right now we have a cost shock for businesses. And it is an empirical question as to where it's going to end up. Is it going to end up with consumers paying higher prices? Is it going to be fewer workers with paychecks? Is it going to be less profits? And we are at the front edge of seeing how businesses are dealing with that really difficult question.
And Claudia, there's this lack of clarity around exactly whether this is a transitory, I hate to use that word, or short-lived inflationary move, or whether it has longer legs. There's also a lack of clarity around the labor market. On Friday, we got the jobs report that the headline numbers seem to suggest was still really robust and better than expected, an upside surprise. If you look under the hood, though, there are a number of analysts who are raising questions, especially with the downward revisions and some of the other modeling that points to maybe a weaker outlook. Where do you land on that, on this dual side of the mandate, when you take a look at the labor side of the equation?
We have an economy that's still largely at full employment. So a 4.2% unemployment rate. We have payroll gains, while not stellar, are still solid. It's, the question is, there are real signs of slowing, and we are seeing some modest slowing. It's not happening rapidly, and that's important. But the labor market, especially in terms of the Fed's thinking, they're close to their mandate. I mean, there is a reason why they're giving such focus to thinking through what's going to happen with inflation over the coming months, because largely they're in a good place on the labor market side. So, yes, and I think it is important to understand that while the labor market has been resilient and things are looking like modest slowing, we don't have the same strength that we did, say, 2 years ago. We have much narrower job gains, like we're down to a few large sectors that are really pulling above their weight in terms of job gains. We have an unusually low hiring rate. Like, we're not set up to really be hit hard in terms of the labor market. But for right now, things are looking really pretty good.
Claudia, it sounds like you disagree with Andrew Hollenhorst, who came on and said that the Fed is fighting the wrong battle and that inflation is in a very different spot than it was last year or even 3 years ago when there was a lot more heat in the economy. He thinks that there isn't as much of a risk on the inflation side and that there is a more significant risk on the employment side. I'm just wondering if, let's say, this Federal Reserve took Donald Trump at his word, cut by a percentage point, would that lead to significant unmooring of inflation expectations and the potential for long-term yields to rise really considerably?
Well, the Fed listening to the president and doing what he says probably won't do good things for yields in general, but just thinking about that, like, could the Fed be cutting right now? So there is an argument to make, but remember, the context is so important. Inflation has been above the Fed's 2% target for 4 years. Right. And even a modest increase in inflation at this point is going to move us further from that. So I think there are good reasons. And we really did get burned by the persistence of the shocks. Even if this time we have smaller shocks to inflation, and I think that is likely the right call here, the persistence of it does risk embedding that we just aren't a 2% inflation economy. And the Fed does not want that to happen. So I think at this point, they can balance these risks and waiting and seeing the surge in inflation comes back down, which I think is, the textbook case. I think that's the most likely case. But the Fed is going to want to see it in the data. And I think that is appropriate at this point.
We get another read on Wednesday, again on Thursday. Claudia, appreciate your view as always. Claudia Sahm there of New Century Advisors. Short-lived or short-lived? What are we going with?
Okay.
Chairman Powell goes with short-lived. It's short-lived, right?
In human talk in the United States, it's short-lived.
Why do they go with short-lived?
If you say short-lived, you sound either like you were educated in Britain or,
We don't say that, do we?
What do you say?
I say short-lived.
You do?
Yeah. What's the short-lived about?
I don't know.
Do they say that? That's maybe. I don't know.
You don't know. You just came from there. You grew up there.
Lived here a decade.
Well, all I know is that didn't another Fed chair say short-lived? Didn't Bernanke say short-lived? And so it's sort of, if you're a Fed chair, suddenly you start speaking weird.
It's a lot of takes out there at the moment. Here's one from Drew Madison MetLife. Worst case scenario for the Fed is a cycle where the Fed cuts and rates move higher, as that could lead to a QE restart, which could cause a further rise in yields. They need to wait this one out. So I've heard that a few times.
As far as QE, I'm going to put that aside for just a second, because that's a pretty big extrapolation. That is a fear. And that's what happened last year. And some people could say it was due to the belief of what a new Trump administration would do to inflation and growth. On the flip side, if they did cut rates and you did see long end yields go up, but that would be terrible on two sides. Number one, that would be restrictive, particularly to the mortgage market, the housing market that already is coming under some pressure. And two, it raises fundamental questions about their ability to control yields and how well they can actually bring inflation into control and whether they actually have the levers that they think they do. And those are two things they don't really want to happen.
Which I think is why Chairman Powell has made it very clear in every single speech, every piece of communication we've had from the Federal Reserve Chair over the last several months. It's about pledging to anchor inflation expectations, which I think has offered a little bit of daylight between him and a certain governor, Chris Waller. Governor Waller, I think I've got a lot of sympathy, others too, with his view on things, that the labour market isn't tight enough to generate the kind of wage price spiral that would lead to the second round effects and much stickier inflation if we do indeed get the pass-through from the tariffs. So he can sit there and say, because of that, I'm going to look through the price pressure from tariffs, and if we do get the weakness in the labour market, I'm going to respond to it and cut interest rates.
And it's unfortunate that this is being portrayed as Chris Waller auditioning for the Fed chair and Jay Powell trying to thumb his nose at the president, because this is a real economic debate, and there are economists on Wall Street that fundamentally disagree on both sides with legitimate arguments. The problem is when you are in a dark room with a blindfold, with fog and lots of people around, and you're trying not to stub your toe, it is a very difficult equation, and that is basically what we're facing off with here.
People throwing grenades into the room.
Well, I hope not. Smoke bombs.
Bond yields right now, just about unchanged on 30s, on 10s at the moment, 450. The bond market just about unchanged. Yields were a little bit lower earlier on this morning, but no drama in fixed income at the moment. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Tropical storm Barbara is gaining strength off Mexico's Pacific coast and could become the first hurricane of the season. According to forecasters, the storm is expected to remain at sea for now, but heavy rainfall could trigger flooding and mudslides on Mexico's western coast. Meanwhile, President Donald Trump says Elon Musk will face, quote, very serious consequences if he funds Democratic candidates who challenge his big, beautiful tax bill. In a phone interview with NBC News, the president went on to say he has no interest in repairing his relationship with the Tesla CEO after their very public feud last week. And turning to sports, the NBA Finals are tied at 1-1 after the Oklahoma City Thunder beat the Indiana Pacers in Game 2. League MVP Shai Gilgeous-Alexander led all scorers with 34 points, while the Pacers couldn't overcome first-half offensive issues. The series now heads to Indianapolis for Game 3 on Wednesday evening. That's your Bloomberg Brief. John?
Yahara, thank you. I love sports. I have absolutely no interest in this whatsoever.
Really?
I was kind of interested when the Knicks were in the running. Now, none at all.
Everyone hates the Pacers. That's the truth. I'm sorry. But it is cheaper to go there and get tickets.
Why do you hate the Pacers?
I don't hate the Pacers, but it seems like a lot of people really hate the Pacers.
Indiana or just the Pacers?
Just the Pacers. That's just my sense.
I just couldn't
Completely ignorant, though, so just throwing grenades, like you said.
Okay. All right. I mean, I'm ignorant and...
and angry.
and angry at the basketball, apparently. All right. Up next on the programme, setting you up for the day ahead, plus Michael Kushma of Morgan Stanley on the latest Fed rate cut expectations. We'll catch up with Michael in just a moment. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. The opening bounce about 44 minutes away. Equities at the moment near session highs, which is positive about 0.2% on the S&P 500. As we count you down to the cash open, just a sneak peek of the week ahead. Today, the US and China resuming trade negotiations at 1 p.m. Eastern Time. Apple's Worldwide Developers Conference begins at 2 p.m. President Trump participating in an Invest America roundtable. On Wednesday, the data starts, CPI, Thursday, PPI, and another round of jobless claims, plus Tesla's robo-taxi launch in Texas. As we look ahead to that inflation data and a sprinkle of debt supply, Michael Kushma of Morgan Stanley joins us now for more. Michael, good morning to you.
Good morning.
Wednesday, Thursday, it's not just CPI, PPI, it's 10-year debt, 30-year supply. Are you nervous about that supply coming into the long end?
It's relentless. The size of the financing needs of the government just never stops. So it's not this week, it's the following week, following month. It just never stops. And the yield curve is steepening. There's lots of uncertainty about the future. It's not clear what the Fed can even do about it. I'm not sure if cutting rates would help the long end of the yield curve, given the current situation, given all the uncertainty which exists.
That said, there's been so much hand-wringing. I have to wonder whether positioning has gotten ahead of what is actually happening on the ground. And I thought it was instructive what happened on Friday. You got a sell-off on the heels of better-than-expected payrolls figures. And the biggest sell-off was at the front end, not the long end.
Right.
And what that indicated to me was that positioning was so short on the long end at this point that you try to get in on that now, good luck. How much is that sort of the story right now?
It's I think it's a big part of it. It's certainly a strong consensus view that the curve should steepen more, even though it's already very, very steep. If you look at the long-term history of 30-year Treasury yields, 5% is all the way back to the 1990s before you see a yield much higher than 5% as a buy in that sense. Only for going back to the 1990s, I think that kind of world where the whole world has changed. There's inflation going on. There's uncertainty about fiscal policy. Real rates continue to rise, and fiscal policy in particular is a bit out of control in the sense that there's no expectation that it'll be reined in. The 30-year will stay cheap. It's a very good question. How cheap is it already, and how much bad news do you need to drive it even further?
Yeah, so we were discussing whether it was a short-lived inflationary or whether it was short-lived inflation. And Chris Nagy wrote in, and actually, I feel chastened. I was making fun of it, but I'm wrong, actually.
What is it?
It's short-lived, that as an adjectival, it's life. Long-lived assets, so that it's actually the proper way to say it.
Short-lived. This doesn't sound right,
It
does
sounds horrendous.
It might be grammatically correct, but honestly, I just no.
That's basically what I'm saying is absolutely not. I reject this. But if inflation is short-lived, if it's short-lived, do you get the sense that 30-year yields will rally, or is this actually something that you could see sustained, even if you have inflation that isn't as big of a concern?
Well, I think that's an important point, that we've seen the Fed sort of stuck between a rock and a hard place with regard to growth, employment, and inflation. We're waiting to see if they have a bias one way or the other. So if we see data still being sticky on inflation, I'm not a big bear on inflation, but it does seem very sticky, especially considering tariffs. So if it gets stuck around, call it 3%, core CPI, and the unemployment starts ticking up, what does the Fed do? Does the Fed say, oh, I should cut rates? That's probably bad for the long end. On the other hand, if they don't cut rates, that's probably good for the long end. If they resist that temptation to protect the economy versus inflation, I think there's a very healthy debate at the Fed as to how you should respond to that.
It's important to understand what you've just said. You're saying that if they cut rates, mortgage rates might go up.
Correct. I'm not sure cutting rates in the current environment, the current information we have, is helpful. And sitting in our hands is probably a better strategy than doing something.
That's exactly what we heard from Drew Mattis of MetLife just moments ago. Same thing.
Yeah, a real question about whether we see a repeat, maybe for different reasons, of what happened last year. But then Drew took it a step further, that the Fed would counter that with QE, bond purchases, to try to lower long-term rates, which raises a question how much control they actually have and what the consequences of that are.
Help us answer that. How much control do they have over the long end?
I don't think a whole lot. I don't think they want to have 30-year treasuries on their balance sheet and interfere with the allocation of credit in terms of market pricing of risk. And I think that interfering with that just supports the idea that they're helping the government, the administration, support their agenda, and hurts the long-term inflation expectations.
There's always things to worry about. I worry about lots of things. Here's one. I don't worry so much about the long end selling off more, although that would be worrying. What I'm worried about right now is the fact that it's not rallying on weaker economic data. That last week the data wasn't tremendous. That yes, there was a headline beat, an upside surprise on the headline number on NFP, but if you take last week's economic data in totality, and the Fed always talks about the totality of the economic data, hasn't been great. 30 years not rallying. How concerned should you be?
Well, I think the data hasn't been weak enough to justify a stronger view that recession's coming, and that even if the Fed cut rates, long-term rates come down because longer term the recession will drive down inflation regardless. I think that's kind of what the Fed is saying, that if unemployment rate goes up enough today, even if inflation goes up, if they don't cut rates, inflation will be below target in a year from now or 18 months from now. They don't want that either. So I think that the real reason for the Fed, the market, is that 30-year Treasuries. Why do I need to buy them? It's a niche market. Who are buyers in 30-year Treasuries? Structurally, pension funds, insurance companies. If they're fully funded in most cases, or in the public sector, they can't buy 30-year Treasuries because they're so underfunded they can't lock in those kind of yields. Who is the structural buyer of long-term Treasuries when the government's issuing billions and billions on a regular basis?
Which is why so much more issuance is taking place now, closer to the front end.
Right, and hoping that inflation does come down and long-term rates do come down in the future, then you can move back out the yield curve.
Michael, good to catch up with you. Clinic, as always, Michael Kushma there of Morgan Stanley. The latest in fixed income. We're looking ahead to CPI data, PPI data, and to Lisa's point repeatedly, also the bond supply on Wednesday and on Thursday.
A true test of exactly who that marginal buyer is at a time where you have seen some of these auctions get pretty messy. A question about whether the U.S. should sell fewer 30-year bonds, because if nobody wants them, maybe do what Japan is doing and just sell fewer of them, and that's going to be an ongoing conversation.
And kill the 20-year. Just sort of get rid of it. Right?
Spirit.
It's not worked out.
It's been a bad option.
20-year yields up this morning by a full basis point.
There you go.
Out
See?
there that holds them. All right, let's give you an update on trade talks over in London. The US and China in the same room right now for another round of talks. This time in London, last time around in Geneva. On the ground, Bloomberg's Annmarie. Annmarie, we've got the officials in the right place. What's next?
Well, Jonathan, this really does just feel like a continuation of the negotiations we saw just a month ago in Geneva. And the contours of what we expect is that the U.S. is expecting more access to those rare earth and magnets, something we heard from the president of the United States after he got off that call with Xi Jinping. And then we heard from Kevin Hassett this morning, the NEC director, the clearest signal yet that export controls are on the table. Now, many people were speculating because we have Howard Lutnick, the Commerce Secretary, now joining Ambassador Greer and Secretary Bessent, part of this trade delegation. And it seems like they're going to be willing to ease the export controls. The question I have is, what is the U.S. red line? Most recently, what we've seen with export controls is the U.S. going after chip design software, also jet engine parts. But then earlier in the year, we saw the Trump administration ban the H20 NVIDIA chip going to Beijing, something that NVIDIA developed to go to Beijing under the Biden administration. So what is the U.S. red line when it comes to export controls? And what does this mean for future export controls? Can they continue to use this as leverage? So that's really what we're looking out for in today's meeting, a continuation of what we saw the last month in Geneva.
Just in terms of the timing, we were told it might be short. Do you think this could wrap up in the next few hours?
I don't really think these things are short. I think both sides are going to come in, still want to air their grievances. I think this will go late into UK evening, and then as well as potentially into tomorrow, we could see these talks continue. Both sides are going to want to really talk about potentially other issues as well, like the fact that the United States revoked visas for Chinese students. There's a ton of issues. What is going on with Russia, Iran, potentially the sanctions, any of those issues come up. There's a lot at stake here. How about phase one trade deal from Trump 1.0? Are we even going to start talking about those purchasing agreements?
True.
I don't expect these talks to be that quick.
Annmarie, looking forward to your coverage from Britain's capital. Annmarie in the city of London this morning. AMH, thanks for the catch-up. Appreciate it, as always. The US and China sort of escalating to de-escalate. We need to get out of that loop over the last few months, which I'm sure has frustrated you all. Mike McKee's going with short-lived. Just to wrap up the show, short-lived?
Well, I think we're all going to go with short-lived, whether it's grammatically correct as short-lived. It just sounds pretentious. I'm sorry. It does. I'm just going to say it.
You're calling the chairman pretentious. A lot of people
are taking real
issues. Coming up tomorrow, Isabel Mateus-Alago of BNP Paribas, Mike Wilson of Morgan Stanley, Matt Lazzetti of Deutsche Bank, and Liz Ann Saunders of Charles Schwab from New York City this morning. Good morning. This was Bloomberg Surveillance.